All right. Well, here we are. We're recording. We turn the camera back on, special fancy camera. And I set it up all by myself this time. So welcome everybody. And we got materials coming in right now, hot off the press. The materials are currently only just to print out the slides. We'll work towards getting like an actual workbook put together. But in the meantime, it's all beta version and brand new stuff. And thanks to Jamie for putting all that together. Yeah. For those I may not have met yet, my name is Alex Fenske. I'm the team leader here at the Keller Williams Elite franchise, and put together this content because a lot of our top agents said they wanted to hear more about stuff like this, the finance end of owning and running a business that really doesn't actually have a lot to do with real estate per se, but just all the business ownership things that probably nobody else ever taught us unless you took some other class about business that wasn't about real estate. So we have a lot to go through today. I'll be stunned if I get through all of the content in 2 hours. So because the first part of it is the part that we didn't get to in the first module. That's part of working through new content. I don't know how long it's going to take. Okay. So there's a lot of really good stuff in here. And just as a teaser, we get to a slide where I show that for many people in common circumstances, if you do the things that we're going to walk through, you could actually have a net business profit of $100,000 and pay less than $1,000 in federal income tax.
I love that.
All right.
We need to hear.
So that's what we're working towards. All the stuff, all the numbers we're going to nerd out on are all going to work us towards that. Okay. I gotta switch over to my presentation here so that my PowerPoint will work. Now, for those that are on Zoom, I am not going to be able to see you, so I'm going to need you to speak up if you have a question, because I'm not looking at the chat. I don't have a chat monitor today. So just unmute yourself and throw in a question if you got one, and then keep yourself on mute if you got any background noise. Sound good?
Yes, sir.
All right, I got one there. Okay, good. So today, I might have to click on here now. There we go. Today we're on module 2. There's 3 modules in this series. And here's the summary of them. Today we're on module 2, build your tax shelter. So first part, we talked about managing expenses. We talked about separating your personal and business money. We work towards understanding a profit and loss statement and how to look at one and get valuable information from it. Anyone here want to throw in any ahas or cool stuff you accomplished after being here for the first module?
Sure. So when managing the business expenses, something that we are still in communication about. I have to definitely still set up this discipline and separating the rent income with the payroll business stuff, and still not gauging the business account as the total operating account when you have multiple entities now. I'm still in the aha moment of how important that is and how much easier it'll be for me to read my P&L once I get stuff out of there that's not supposed to be there.
Yeah, a lot of us are in more than one endeavor, right? We've got our sales practice, but then we might have other stuff. If you own rental property, that's a completely separate and unrelated business line. And if you're running that out of the same checking account, you can't use the checking account to know how either business is doing. And if you got them intermingled on the same P&L statement, you can't use the P&L statement to know how each of those are doing. If you work towards separating them out and having each business that you have its own banking and its own P&L, and all of that being separate from your personal banking, you can actually know what's what and look at it.
The numbers will be clearer.
They'll be much clearer. Yeah, good. And you're on the path there. Glad you're taking action.
Did you hire your accountant yet? I've been him.
Yep.
But they are both, Alex and my accountant, are fussing. Nakia, you really just should clear that up, like it shouldn't be doing it.
Yeah, you've got to separate them out or put them below the line.
Yes,
So that it's not, all jumbled up in the same numbers.
yes.
Anyone else want to report back or are we ready to go?
We're ready to go.
All right. Well, so today we're gonna talk about anticipating income taxes. We're gonna go through the various options for business entities, including a conversation about what self-employment tax is, why you need to know about that, and how you can work around it. And then we're gonna go through a bunch of different types of accounts that have tax advantages. And that starts with retirement accounts, but we're gonna go through some other trust accounts. And look at some of the possibilities there. Next time we get together, which I haven't identified the date, we're probably looking early December because of Thanksgiving and stuff. We're right in the middle. There we're going to go into real estate investment for agents. So going into the unique advantages and challenges that agents have when it comes to investing, right? Our challenges are always around financing usually, but our advantages are around insider information and how do we make the most of our situation. So we'll do that at the next module. And maybe anything we don't get to today, we'll get caught up on, kind of like we're doing today. Here's my good disclaimer. So for anyone watching live, recorded, in person, here's what I'm not. I'm not an accountant and I can't give you tax advice. I'm not an attorney and I can't give you legal advice. I'm not a financial advisor and I can't give you investment advice. I'm not even a managing broker. So I don't even know that I can give you real estate advice.
Yes, you can.
So take anything that I'm telling you with a big grain of salt. A lot of this is very, very overview level. And these concepts are inherently very complex and customized, meaning the same, if we both have the same type of account, mine might get treated different than yours based on other variables and factors. So take what I'm telling you and use this information so that you know what questions to ask a professional. Okay. And so that you have the right professional that you're working with. Some of you will go through this and you go, why didn't my accountant ever tell me that? You might not have the right accountant. Right? So this is just so that you know what questions to ask and you know what's out there. All right. Okay. Today, here are the three sections we're going to go through. We're just going to look at understanding how income tax works. We're going to talk about selecting a business entity, and that has direct income tax implications. And then section 3, we're going to go through all those different ways to minimize taxes through those accounts. The learning objectives are for us to walk through a basic calculation of income tax. A lot of people have never seen that, never done that, don't know how it works. We're going to do a very basic version of one. We'll help you select what you think might be the best entity so you can go to your professional and ask and get that confirmation. Learn about self-employment tax and how to legally avoid it. By the way, when we talk about tax, the word avoid is okay. It's okay to avoid tax. It's not okay to evade tax. Evading is illegal, avoiding is not. So I'm conscious about my language usage here, and it is legal to avoid taxes by using legal ways to do it. I always joke is that all the senators make all the rules so that it benefits them, but we can use them too. Yeah. So you could be like a senator today. How's that?
Hey, Alex.
Yeah.
No, thank you.
Do you have a copy of the presentation? It's really hard to see the monitor.
Is it you? Oh, you know what?
Did you email it?
There's a step, Rob, that I have failed to do, and that is the sharing of the screen. I'm sharing screen 2. Now, how's that?
Awesome. Much better.
Here we go.
That's better.
Thank you for bringing that up. I've not done this before with this specific equipment, and so I'll have to step out. Thanks for bringing that up. So we're going to learn how to legally avoid self-employment tax to a large degree. Narrow down your retirement account options. There's a lot to look at, so you might just have an understanding of those and know which ones you might want to look at. And then we're going to check out some other lesser known tax advantaged accounts and a little bit about self-directed accounts. If we get there, we'll see. So section 1, planning for income tax.
Is this left over from the last one?
This is what I initially intended to cover this in the first module. We didn't get to it.
Okay, I'm just making
It
sure.
actually makes more sense with this module.
I think
So
it does.
yeah. So tell me if this sounds familiar to anybody. I like to call it affectionately the spiral. So you live on your commissions, they come in, you spend them, you use them. You don't plan for taxes, right?
No, we never do that.
And then you get your tax bill
Like, oh, shit.
and you're like, oh yeah, I don't have that money that you
That's
say I
not what you
owe.
say. You don't say, oh, yeah.
Well, it's recorded
You
content,
say,
so.
oh.
I'm not saying what you might actually say, but you get that bill and you don't have the money because you used it already. Then, if you're a good person, you get on a payment plan because you're gonna make good with the IRS. You get on your payment plan, start making your payments to the IRS, and now you're paying last year's taxes, but you're doing it with this year's income. The weird thing about that is that you're still gonna have taxes on this year's income. And so there isn't enough of this year's income to pay last year's taxes and save for this year's income. So then the tax bill comes due next year and you again don't have the money and you're just going down this downward spiral of payment plans on payment plans on payment plans. I'm not going to ask who has experienced this.
See, I didn't know you were telling my story.
But this is very common in real estate because you take a bunch of people that by and large have worked at a W-2 job where a lot of their taxes are withheld. And you start giving them big commission checks that are inconsistent. And, we're not planning or we don't know all the stuff we're gonna talk about today. And it's really a recipe to create exactly what we just talked about. So it's my goal that with the stuff that you learn today, that you can stop that spiral or avoid it. Sound good?
Thank you.
All right. We're gonna get super nerdy, by the way.
I'm not gonna talk to you.
Oh, yeah. So first off, let's just take a basic scenario and say, hey, you close a good sale, you get $10,000 commission check. All right. So what happens next? Like,
You go spend it.
yeah, right. So, I mean, there's a lot of different ways this can go. You can have $10,000 drop into your personal checking account with everything else. You could have it go into a different business account, and then how do you treat it? How do you handle it at that point? This is the question that a lot of us don't answer, and we just do whatever is default, which typically is it drops in our personal checking account. It gets used up on organic groceries and whatever, and then it's gone, right? That was a statement about himself. I mean, seriously, I was talking to somebody recently and I'm like, listen, I live on my base salary from this role and my base salary that I pay myself out of my sales business. Any other bonuses or anything like that gets scooped right off of the top and thrown into my personal savings account because otherwise it'll get squandered away on softball equipment and organic food. It'll just be gone. Whatever is there will be gone. So you put the amount there that you're okay with being gone, right? So there's different ways to handle your commissions. Now, we already talked in the first module about separating your accounts. And I think that's a really important concept, especially if you're gonna come up with a way that you're gonna treat your commission deposits. So one method is to live on the commissions, and what that means is that you take money personally when you get money from the business. It's not wrong, it's not bad. I like to teach getting to where you can put yourself on a salary, but it takes some time to get there. This is where your commission deposits hit your business operating account, and then you're going to split that money up. So you're going to take a certain percentage of that and move it to your personal checking account to live on. And then you're going to take another percentage of that and move it to get a different account, probably a savings account, anything that doesn't have a debit card tied to it, right? And you're going to put that aside for tax. So again, this method A is money drops into your business operating account. You move a chunk to personal, you move a chunk to tax, and the rest of it may stay in your business operating account. That's one way of handling it. You have to determine what those amounts are, and that can be tricky. And that's one of the disadvantages of this method is like, well, what percentage of that do you need? Well, I guess that depends on how big the check is and when's the last one I got, and do I have any more coming after that? It still can be very, yeah. And what may be the right percentage this check might not feel like the right percentage next check. So this, you kind of have to keep reinventing this and rolling with it. And that's one of the disadvantages. But I just want to point out, a lot of people will tell you, when we talk about saving for taxes, people always throw this number out, 30%. But you got to understand what you're taking 30% of. I don't think it makes any sense for you to take 30% of your gross commission check.
Yeah.
Well, that's what a lot of people say, right? Set aside 30% for tax. Well, hang on. You got all these business expenses. If you're running a team, you're operating at a 40% profit margin. You can't take 30% of your gross profit.
You don't have nothing.
Like, you have all these operating expenses, and you don't have to.
No.
That's not necessary. Your effective income tax rate, again, it's going to be 12, 13%, 4%, 8%. That's going to be your effective income tax rate on your adjusted gross income. You don't need to set aside 30% of your gross.
Just calculated that because again, I hear this in my ear. I'm trying to make the right steps for next year. 'Cause
Yeah.
I don't want to feel like I did this year. And I said, okay, you capped. Not all your check, just put 30% to the side. And I'm like, when I calculate, I'm like, is this what I'm gonna have to do everyone? Like, that's probably why I never did this.
You don't need to do 30%.
Okay.
Because what the money that hits your checking account is what we call your gross profit. It's not your net profit, because you still have all your operating expenses that you pay out of your checking account, but it's clear of your cost of sales, right? Your company dollars already been taken out, your team member splits and all that crap, your referral fees already been taken out. So that your money that's after your money that hits your bank account in real estate, that's your gross profit. And then you use that to pay your operating
Chicago
expenses.
Southland Homes, can I help you?
Got your question? No? Okay. All right. Angie, are you unmuted on accident? I think that was Angie.
Oh, it might have been. I'm sorry. I just answered the phone.
That's all right. So you don't need to set aside 30% of your gross profit. That's ridiculous. Like, I mean, if you were pulling in a net business profit of 3 million a year, perhaps you would have to, because a lot of these deductions and credits and stuff are a drop in the bucket at that scale. But that's not the rooms that we're in here that we're talking about, right? Someday we'll talk about that. Right now, why don't you start to set aside 10% of what hits your bank account for taxes? It's better than 0%, isn't it?
Yeah.
We've talked a lot with, a lot of the people that are here right now. We've talked about when perfectionism gets in the way of progress. And we've talked about how it stalls you from action. And if you perceive 30% as too high to set aside, and as a result, you set aside 0,
Right.
well, that's not serving you. Why don't you try 10? Better than 0. And it's probably gonna be enough.
With that 10%,
Mm-hmm.
like literally you make it disappear, right?
Yeah, so there's different ways to do that. I mean, for sure, a separate account, you likely would want that in a savings account. You could make it a business savings account and it never goes into your personal money world. Or you can make it a personal savings account. It really doesn't matter. Some people go so far as to initiate a transfer into an external bank. For example, I have a couple of personal savings accounts with American Express. There's no card, you can't, if I want to transfer money, it takes like 3 days, Some people do with a credit union that's like stuck in 1963 and they don't have electronic banking or anything. And like, you have to like send the money there and like, it's hard to get it out, right? If you are afraid of your behavior, you might want to choose a place like that where like, you can't take, you have to look sideways
I
at
have
that
a
one.
t-shirt that says
Afraid of my behavior. Yeah. I have a t-shirt that says I'm afraid of your behavior as
Yeah,
well.
I know. Around me. I've always seen that one. Around.
Yeah. So I would, I mean, do what works for you, but have that in a separate account and make that the only thing that it's for. And try 10% of what hits your account. It's better than 0. We're going to go through a sample of how to estimate your tax. I honestly don't recommend you do that. I don't do that for me. My taxes are far too complicated for me to try to estimate. But I got a bookkeeper and an accountant. And at certain points throughout the year, I go, hey, what do you think I'm going to owe? Hey, if the second half of the year looks like the first half of the year, using the information you have about all my deductions from last year, where do you think I'm going to land? What do I need to do with estimated tax payments? And they tell me.
So question.
Yes.
With this money set to the side, now you pay quarterly taxes? Or
We're going there.
Okay.
We're going there. I just want you to define what are you going to do when the money hits your account? Write it down. Start with something, right? The other method, and we talked a little bit about this in module 1, is to live on a salary, where instead of living on the commission income when it hits, you're living on a salary that you pay yourself. And I know this is not everybody can just pick up and do this. You have to have enough of a cushion in that account to start. And you have to have enough of a pipeline that when you have a lower production month, you might dip below a certain threshold in your checking account, but there's still money in there and you're living on that consistent income. I think this changed my entire financial life when I was like, oh, I can do that. I was like, oh my God, now I can have a budget for my household and I know how much money I'm going to make. And, you know, there were absolutely times where it got low, or I maybe even had to pull money in from the savings account so that everything was there. But
You made the adjustments.
yeah.
Was there a lead up to where you were able to do that? Meaning like, the question I always have is the consistency of business, right? 'Cause
Right.
I love to say it's always consistent.
Right.
And yet that's the thing for me that
Right.
has historically
Well,
pulled us off.
You're gonna need to go sell more houses.
Right. I mean, did you have to do it? Does that ever drive you? Like when you're going, all right, this salary's coming no matter what, we got to make sure the team is producing X.
So at the time where that idea was brought to me, I actually was driving enough income that I didn't have to sell more. Come on. So I was fortunate at that point where I was able to go and do that. But I also set my salary as low as I possibly can. Like, no joke, and I was telling Patricia about this. There are many months. There's probably no months that go by where I don't get the low balance alerts on my phone when it gets towards payroll at the end of the month. And there are many months where that account, I will let it withdraw. There's other people that have access to that account.
Right.
You might not be as aware as I am of all the things happening within it. And there is a real thing that happens when people look at, when you look at the gas tank on E, you drive different, don't you?
You showed
Yeah.
Yeah.
So I-
need to go there.
So I set my salary as low as I can possibly make it. And I've only adjusted it in recent years because my freaking kid had to go to private school. Yeah, so.
That's
So
a
I
good
bumped it up
adjustment.
a little bit,
Yeah.
but I set it very low. And we live on that.
So that thing called salary
Uh,
and then payroll,
uh,
same thing, right?
yes.
Because on that salary, now you're paying payroll taxes.
We're gonna go into how much you should make your salary and all that.
Thank you.
Payroll, we're gonna be going
Oh,
all that.
these things that I'm having fun.
Yeah, we're going all that.
Right.
So if you decide to, work towards where you're on a salary, the way it typically looks is your commission deposits are going to hit your business operating account, same way they did in the first sample. But in this case, you're going to move a preset percentage into probably a business savings account for taxes. And you are not going to manually transfer any money to your personal account. You're going to have yourself on a payroll, and there's going to be a predetermined amount of money that goes in your personal account, and it's the amount that you live on. The other way to do it is some of it's salary and some of it you could just take as a distribution, right? Because at the end of the year, you're going to have some of your money that you took out of the business in salary and some that you took as just profit or distributions. So you can make a combination. We're going to go into that, but ultimately, when you're living on a salary, it's automated. You're not discretionary pulling money out of the business and stuff. You just got to get the pipeline to do that. I really think it's a better way to live your personal life by knowing how much money you have to live on. So you can make a budget like normal people do, like who have jobs and stuff. And like, it's kind of wild, right?
So I know I'm late to the party. Thank you for your patience and your grace.
Absolutely.
So you're talking about method B right now.
Yes.
Thank you.
Yep. We're just talking about different, what happens when the money hits the account instead of just squandering it all.
Okay.
Right. So these are just two ways that you can handle it. Now there's little differences in terms of how, if you read Profit First, they have a specified formula of when it hits, you have this account and put this percent and this account, put that percent. If that works for you, cool. I mean, that's not how I do it. I kind of do it like method B here. But it's not totally like method B. Like I kind of use method B, but I have a business savings account. And I just have kind of a threshold where when the cash in the operating account gets to a certain point, I just pull a big chunk over and I throw it in savings. And again, I'm taking my gas meter back down to quarter tank, right? So I'm not driving like an idiot. So there's two possible ways. The important thing isn't that these are not end all be all. The important thing is that you're purposeful with what happens when the money hits. have an intentional plan about what you do with it, and that plan includes taxes. It just has to include taxes, even if it's only, we're talking about 10%. You don't need to set aside 30% of your gross profit for taxes. Your tax rate is never going to be that. Set aside maybe 10% of your gross profit if that's what's going to get you into action. And who knows, at the end of the year, maybe it's not enough, but you might owe a little bit instead of the whole thing, and you haven't set aside any.
So you recommend 10% versus 30?
You'll never need 30. You know, a lot of times people will say, hey, take whatever commission deposits hit your bank account and take 30% of that. Well, that's your gross profit. That doesn't account for any of your operating expenses.
Good point.
It doesn't account for any of your standard deductions, doesn't account for child tax credits, doesn't account for any of that stuff. It doesn't account for if you have rental properties and you have deductions that you're taking against your active income. Your tax rate is never, your effective tax rate is never going to be 30% of your gross profit.
That's like,
It will never be that
you
high.
gotta be like making 10 million a
Yeah.
year.
Yeah, you have to be close to a millionaire in order for your tax rate to be that high. So it's just not going to be that way. Just set aside something for taxes and do it with conscious intent. That's all. How much? All right, we're going to go through a basic calculation of taxes. I want to show you what the tax brackets look like.
How married are we?
How what? How married? You're hilarious.
That's not this class.
So these are the 2021 federal tax brackets. I want to explain how these work. So if you're an individual, you can see there's a range in each of these, right? What this means is that a lot of people think that if you made, in this example, $165,000, which is greater than that all of your income would be taxed at 32%. It's not how it works. How it works is the first $99.50 is taxed at 10%. And then the next, whatever is between $99.50 up to the next threshold, the next 31 grand is taxed at 12%. And the next, like, it's not like all of your income is taxed at that
It's
number.
incremental.
It's incremental. Each level of income is taxed at that level of income's rate.
Right.
So, because I remember one time I was talking about, because we always play these games at the end of the year, I'm on the phone with Angie. I'm like, all right, so if I drop this much more as an employer contribution to the 401k, what happens to my tax bracket? Do I get under the threshold? Like, what do I got to do to? But it's not. But I'm only minimized if I'm $5,000 over a threshold and I get under the threshold. It doesn't magically change the tax rate on the whole thing. It just means that none of the income is taxed at that next higher rate. So that's one just big misunderstanding that I had for a long time. And again, this is on your adjusted gross income. So I'm not going to go into politics, but I will say that when I hear a lot of people talking about plans that are for people that have incomes of 400,000, guys, that's not your gross income. That's your adjusted gross income, which in terms of IRS is after every deduction on earth, every tax credit on earth. And in order to have an adjusted gross income of $400,000 in real estate, if you are running at that level, you're running a team. If you're running at optimal profit margins, you have to have gross income of over $1 million. So just pay attention to what it is that you're understanding when we talk about what these tax rates are. And we're going to go into what some of the deductions are, because what you think is your taxable income probably isn't, right? This is how the tax brackets work. Now, being married, because you're not two separate people filing two separate tax returns, they give you a break.
Why are we not?
Why are you not married? You are.
No, I mean.
Well, I don't know. Listen, they wanted people to be married or something, so they made laws that said it's cheaper to be married. So I don't know. Just follow it if you want, right? So the married tax brackets, the numbers go up higher before the rates increase, right? So if you're a married couple filing jointly and you have net business profit of $100,000 and you have a couple deductions, there's a standard deduction in there, you might end up at somewhere in the 12% tax bracket. Well, because if you had 100,000 and you had a couple of deductions and a $25,000 standard married deduction.
This is out. Okay, so some of us who are taking salaries and distributions. So Is that the salary and the distributions combined?
Yes, and we're gonna go there.
Okay.
All right. I just want you, the first thing I want you to understand here is how the brackets work.
Yeah.
And then the fact that this is on your final adjusted gross income, which is after all of your deductions, business, personal, itemized, all that crap. That's what ends up here. In Illinois, you're, as an individual, that income, it's calculated about the same way. The deductions and credits are different, but it's flat at 4.95% of your income. There's also, we're going to go into the S corp taxes and stuff. There's what they call a replacement tax of 1.5%. These are the taxes that you really need to be aware of. So a lot of people just learn something about the way the brackets
Yeah.
work?
Yes.
Yeah.
A lot. Well, do we have to say that in our aha, or can we just say that after aha?
You're killing me. So I said, like, if you're married and you had net income of $100,000 for your household, and then you're gonna get a $25,100 standard deduction. That's a deduction that everybody gets no matter what, okay? If it was 100, then it's actually 74.9. So when you go, well, how will I be taxed on my 74.9 adjusted gross income? Well, is that greater than 81,000? No.
It is not.
No, so I'm gonna be in the 12% tax bracket, which means the first 19.9 is gonna be taxed at 10%, and the rest of it will be taxed at 12%. My effective tax rate is going to be about 11%. That's why I say you don't need to set aside 30% of your gross income.
Thank you.
We're talking about 11% of your net
I know,
income,
right?
right? So don't let setting a bar that high stop you from setting aside money. If you're an individual, your standard deduction is $12,550. That's for 2021. There's also a child tax credit. Not everybody has children. I don't recommend having them for tax purposes because they cost a lot more than this. But if you do have them, you get a tax credit for them. Now, a deduction is different than a credit. Anyone explain that? Can anyone tell me what the difference is?
Between tax credit
And a deduction versus a credit.
Everybody gets a deduction. You have to qualify for.
We have to qualify for either of them.
Oh, you
The
do.
difference is a deduction means I have $100,000 of income. I'm going to deduct 25.1.
Oh, and
Then I'm going to calculate my tax rate on that.
Right, so it doesn't, the credit doesn't affect your tax rate.
A credit means I've already done all the math. I have my final income tax liability that I owe, and I'm gonna, and the credit reduces that.
Comes off the bottom line is about.
Yes,
Okay.
exactly. So tax credit directly reduces your tax bill, not
Reduction,
reduces your
reduction
income.
Reduces your.
Yeah, so that's the difference between a deduction and a credit. So everyone gets a standard deduction. Now, there's a whole other thing. If you itemize your deductions, because they add up to more than this and blah, 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 go talk to your accountant. Everyone gets the standard ones if you choose those. Your tax credits, at children up to 5 is $3,600. Children over 5 up to 17, it's 3,000 a piece. This year is the year they started sending those out in advance.
Yeah,
If anyone's
they're
getting
sending them out in
checks,
advance,
yeah.
yeah.
And it's the same money, they're just
They're
giving
just
it to
giving
you
it to
early.
you, they're fronting it,
Yeah,
yeah.
yeah.
So you don't
So
get it
sell it to
again?
the surface
No.
from the age of 5.
Yeah, for the $600, yeah. Yeah.
Useless. They're just useless.
Nikki, you had a question too?
My son just turned 17, so.
Yeah, well, Rob's due for a baby in December, best month to have a baby, because you get the whole tax credit for it.
December 29th?
Yes, sir.
It's
Yes.
so- It's so rough to do.
Have that, all right? Very strategic thinking. So, all
So
right,
I can trust those checks that have come in the mail? is what
Yeah,
you're saying?
yeah.
Literally
they're
have
not gonna
cash
come
on
off, they already came off the taxes that you haven't actually calculated yet. So I mean, it's just an advance on a credit that you would have gotten. They're real, but
Right.
we'll use 30% as an estimate of total tax liability for going forward, but not 30% of your gross income. We're gonna use 30% of your net income. That's inclusive of the state tax too. So I'm saying conservatively, 30% would be all of in this area plus another 5 for the state. So we're gonna say 30%, but not 30% of your gross or your gross profit, 30% of your net income, including state taxes, okay? We good with that? This stuff's all on the IRS website. All right, I'm gonna walk through a sample here. We kind of talked through a little bit already. It's not actually a quiz. But if that makes you feel better.
This is quick.
It does.
So if you're married filing jointly and you have no kids and your spouse doesn't have income, so you're sole breadwinner, you're married, you're in real estate, your spouse doesn't work. and you have an S corp, we're gonna get into that. I just have to use this as an example. Let's say that you're through your S corp, you paid yourself a $25,000 salary and you had a net profit of 50. So your combined income was from those sources was $75,000, right? Okay, so let's see, what does that mean? This is a reasonable example, right? That's why I'm picking something like, okay, let's say you're married and you work and your spouse doesn't and you make 100 grand. You had some deductions, you're at 75. Which federal tax bracket are you in? Remember, it's
There.
each chunk of income is taxed at that percentage.
Right.
So you're gonna take your 25,000 salary and your $50,000, that should say distribution of profit, not dividend, I apologize. And then you're gonna take out that $25,100 standard deduction.
Right.
Married couples filing jointly, standard
Standard
deduction.
deduction.
That means your adjusted gross income is actually 49.9. So at 49.9, as a married couple, you're in between these two, right? So you're gonna have income taxed at 10 and income taxed at 12, but you won't make it into 22.
What's taxed at 10 and then what's taxed at 12?
The first $19,900 of income
the-
is taxed at 10%. 10% on that first chunk.
Okay,
And then the next chunk is actually 30,000 because you're 49.9 minus the 19.9 of the first bracket.
Okay.
So you got 30,000 that gets taxed at 12%. That's $3,600. Your total federal income tax would be 55.9. Okay.
so you make.
So that's 75 grand in total income, and you paid 55.90 in tax. It's not 30%, is it?
No,
Because it's standard deduction. State tax, well, same 75. Now that all the deductions and credits and standard and all that crap works different at the state level. They call it a personal exemption. It's the same as a
Same
standard
thing.
deduction. So it's $23.25 per person, married couple it's $46.50. So that means your adjusted gross income is 75 minus standard deduction, personal exemption. It's 70,350. 4.95% of that, you get 34.82 in state income tax. In this example, I said that you had an S corp that had some income. It was a small tax on the S corp profit. That was 50 grand. You have a $750 replacement tax, just for the sake of the explanation. Replacement tax was a tax that the state instituted when they changed the law that said that the state could no longer collect tax on business property. I don't mean like real estate tax. I mean, like they used to be able to tax stuff that businesses owned, like assets. And they were like, no, you can't do that anymore. So they said, instead of taxing all that stuff, we'll tax income at 1.5% of whatever the
Do you, so in
corporation.
addition to other taxes you're paying on the assets, you gotta pay another tax on top of that?
Well, it used to be that way, yeah.
Oh, my God.
So they got rid of that and they call it a replacement tax. It's small, in most cases.
No,
it's on your
it's
next
small
bill,
to
but-
us, but I'm sure they making some bank on it.
Oh, sure. God knows they need it, huh? So what would be, we talked about effective tax rates, right? Effective means like, how much tax did I pay and how much income did I actually have before all the paper games of these deductions and credits and all that stuff, right? Well, you had 55.90 in federal tax, 34.82 in state income tax, 750 in replacement tax to the state. So you paid a grand total of 98.22 in taxes on $75,000 of income. 13%. Okay, not 30. So don't think you gotta set aside 30. Set aside, maybe set aside 13. I don't know, 10, 13, 15%.
Lucky 13.
Okay. I'm ripping through some math here. I know sometimes we lose a lot of people at this point. Are we following though so far?
Yeah.
Okay, all right, cool,
For schedule.
cool.
The shizzy.
Let's talk about estimated tax payments. We're not gonna go through a bunch of math on this one. Just a brief explanation. When you work for somebody as an employee and you get money via W-2 on payroll, your employer withholds income tax from your pay. You're like, I have this many deductions or exemptions or whatever, and they use that to say, okay, we'll withhold a certain amount of income tax. They actually take that, send that to the IRS, and then when you file your tax returns, you sort of prepaid some of your taxes. That's what your income tax withholdings are when you have a job and you work for someone else. Then you get into real estate, you stop doing that and you go to the spiral. So if you don't pay your taxes through withholdings, or you did, but it wasn't enough, then you will probably have to pay estimated taxes quarterly. And you generally need to do that if you expect to owe at least $1,000. That's the threshold at which you're supposed to make estimated payments. So if I withheld, in that last example, the federal income tax was like $5,500 or something. If I withheld $3,000 throughout my payroll throughout the year, but my actual tax ends up being $5,500, I should have made estimated payments. I'll probably have a penalty because I didn't pay my taxes in time, right? It's paid quarterly, both to the feds and the state. And there are penalties for underpaying, and your bookkeeper or accountant should be telling you how much to pay, or doing it for you, or saying, here's the coupons, just cut the check and send them in. I'm not gonna try to. You shouldn't be spending your time on trying to calculate
Figure it out.
taxes. You shouldn't. I went through that example with you so we all understand how income tax brackets work. But you shouldn't be spending your time doing that. You should be spending your time going on listing appointments. Right?
And cashing your checks.
Yeah,
you know.
just looking at the direct
Right.
deposit. Any ahas from that we've covered now, a basic understanding of income taxes. What'd you learn? Yeah.
I'm estimating too much holdings on taxes, so 30% I do not have to do, but I definitely just had a ton of bricks lifted off my back because 10%, especially when we look at the math, that's a new discipline that I'm setting up.
Cool.
My reality check is I'm tired of receiving a tax bill and saying, okay, now I have to pay it. Or you're celebrating what you think are earnings in that operating account, and then all of a sudden the IRS wipes it away because you owe taxes. So I want to create a new discipline for 2022, and I will definitely have a separate account to where discipline 10% is withdrawn off each.
Cool. Yeah, you will eliminate that bad surprise.
Yeah.
Good. Anyone else want to share?
Well, man, I didn't understand how brackets worked on so that was great. And also, I mean, the 30%, I was exactly the example of like goal of setting 30% aside, sometimes doing it, sometimes not. And then also just seeing this giant chunk of money went over here, we're struggling. I'm like, what am I doing?
Yeah.
So that makes more sense.
Yeah, the bar really isn't that high to set some money aside, right? So don't let that stop you. Something's better than nothing. And 10 or 15% is probably not. Yeah. All right, let's keep rolling. Talk about selecting business entity. Who in here already operates their real estate practice? Meaning you receive your commissions into a business entity. All right, cool. Do you know why it is the one it is?
Hmm?
Do you know why you have the business entity you have, or you're like, I don't know, somebody told me.
Export to, separate well, I was told that it needed to be formed into an S-corp to collect commissions, to pay less taxes versus where I was collecting everything in my personal name and paying higher taxes.
Yep, yeah, that's, I'm not gonna tell you guys which entity to choose, and there ultimately are a couple options that probably make sense for almost all people in our business. But it'll be up to you to talk with your professional to get that, because again, some of us have spouses that have different businesses and income and other considerations. So I can't tell you for you, but we're gonna go over the common types. We'll go through some pros and cons, and then we'll go through self-employment tax and why that matters here. So here's the primary types of business entities. You got sole proprietorships, partnerships, corporations, and LLCs. That's about all there is. Anything else is sort of a subset of one of those. All right, here's a business structure. We've all heard of these things, right? You've heard these words. They're not unfamiliar entirely. Okay,
What's a C corp?
we're going there.
Oh.
Yeah. Yeah, quick disclaimer. I believe this is the way that the license law is written. If you're receiving your commissions, it's got to be, you have to be the only owner of that. Meaning I can't have a partnership with my brother and my real estate commissions are going into the account because he's not licensed and his name wasn't on that deal. So just know that as we go into this section here. And Robin was giving me the head nod. Remember, I'm not a managing broker or anything else qualified to tell you anything, so don't listen to me. Oh yeah, big, massive disclaimer. Here's all the things I'm not. So let's talk about what each of these are and their pros and cons. Sole proprietorship, it just is just someone that's like, you know, hey, I'm gonna go open a lemonade stand and here I am, right? The pro is it's easy. There's nothing to do to set it up. You already are you, and bam, there you are. That's it. That's the only pro I got. There aren't, should have made it singular, pro.
Yeah.
There are no tax benefits and there are no legal or liability benefits to operating a sole
You
proprietorship.
have no corporate veil.
It's nothing, yeah. So it comes with high risk and high costs, but it's easy.
Oh, I like that. Corporate veil.
Yeah, the corporate veil of protection. We're gonna talk about that.
Touche.
Yeah, we're gonna talk about that.
Corporate veil.
Yeah, they talk about piercing the veil. Yeah. A partnership is the same
And
thing.
that's another reason why you tell us, get those accounts separate.
Yeah.
Cause that's the first thing they do in court. They go see if you were commingling those
Right.
funds. And when they see that you were, well, you pierced the veil, so that eliminates your protection.
Right.
Oh, wow.
So and we're gonna cover that in just a second here. A partnership is the same thing as a sole proprietorship. It's just with more than one person. So there's nothing to form. You don't even need a written partnership agreement. A partnership is just more than one person that decide to do some stuff together.
Do some stuff.
And the pros are that, again, it's easy. The cons are, again, you have no tax benefits and no legal or liability benefits. Most people in real estate start as a sole proprietor, and that's probably the best way to start. You don't need a business entity immediately, but when you start making money, you really should have one. We'll show you why. A corporation is the you know, the original type of business. It was a C corp. We call it now a C corp. Back in the day, it was just a corporation. That's the only thing a business was. All this other stuff didn't exist. The problem with the C corp is it doesn't work well for small businesses because of something called double taxation. Now, the big companies that you know, General Electric is a C corp, right? That means that the business makes a bunch of money. The business has a net profit. The business pays a corporate income tax bill on their net profit. And then the business takes that net profit and pays it out to its, you know, shareholders, right? All of its owners. And then those people receive that money as income and they pay tax on it. So that money is actually taxed twice. The corporate profit is taxed and then it's given to the owners personally, and then the owners personally are taxed. It's called double taxation. And that was a downside of C corps. Now at a certain scale, you really have to do it that way because of so many different owners involved in the scale of the business and stuff. But it doesn't work well for small businesses. So eventually they said, we're gonna have a corporation, but we're gonna call it an S corporation. And if you think of S just meaning like small business, right? It's technically a corporation with an S election. And it has all the benefits of a C corp in terms of, you know, tax, the tax possibilities and the corporate veil, which we're going to touch on a little bit. Except you don't have double taxation because the profits aren't taxed before they're passed through to the owner. There's no corporate level of tax. So you have your S corp has a net profit, and that just flows through as income onto your personal tax return. So it's not taxed twice; it's just taxed once personally.
So that's a myth that S corps are taxed twice.
S corp is not taxed twice.
Thank you.
C corp is. Yeah, double taxation is why the S corp was created.
Was existing.
Yep. Everyone follow?
Yeah.
With an S corp, the pros. Ooh, that ended up real small. So I gotta love my language. I said there's theoretical liability protection. Now, as Nikki mentioned, there is such a thing as called the corporate veil of protection, and that means that because your S corp or your corporation is a separate entity, that there should be a separation to where if things happen in and because of the corporation, that you personally can't be held liable for them. And you have to keep separate banking. You have to have board meetings, even though you're the only person on the board. You can have a meeting with yourself and have minutes. I've had to do it. I mean, like, no joke, like, here's my meeting minutes. Which can get kind of funny. Like, I always want to play around with it and act like it's like a Monty Python sketch.
Roll call.
Right. But also you have to think about the fact that if you're operating an S corp and you're the sole owner and the sole employee, and if something happens in the S corp that you personally did, and you're the owner and the only employee,
Right.
you might not have the liability protection that you really think. And so it's also fortunate that, you know, we're not doing something like, we're not running like a cliff diving business, you know, we're in real estate. So I always say theoretical liability protection because it is pretty easy to pierce the corporate veil of protection with a sole operator with a corporation or an LLC. So talk to your attorney. The S corporation is best for sole member businesses or if there are multiple owners, even distributions, meaning there are contributions, the money that people put into it, and there are distributions, the money people take out of it as profits, right? So if you have more than one person that's the owner of an S corp, but all the distributions will be proportionate to the people. Like, hey, I put in 30%, therefore I get out 30%. S corps work well for that. They do work best for if you're going to be paying yourself a salary and earning active income as opposed to passive income. Passive income is not, there's no self-employment tax on passive income. That's why the F corp is here, because it helps you minimize self-employment tax. It also can open up other opportunities because you have an employee. We're going to talk about one of those being the 401k. You have to have an employee in order to have a 401k. Well, if you can't be an employee of a sole proprietorship, you are you. So it opens up some possibilities there when you have the S corporation. It can also be easier to borrow if you're looking at borrowing as a corporation versus an LLC, because it is technically a more official, you know, bona fide business. So those are a lot of the benefits. The cons are you have your corporate compliance, and that's what Nikki mentioned with you know, your board meetings, and you're making sure that all of your stuff is all separate and all that. You do have to file a separate tax return. Do you guys remember when Mitt Romney said corporations are people too? Do you remember that? It was a gaffe, you know, he was doing some kind of a debate, and somebody said something about corporations, and he said, well, corporations are people too. And it became, you know, a news bite because it was hilarious, right? I think that's funny. But a corporation is actually a separate entity. So it really is like, it's a separate person from you. It's not you. So I laugh about it all the time. Corporations are people too. So, but you have to file a separate tax return. So it costs money, you know, and costs extra prep to get that done.
More money.
The setup, I recommend that you work with an attorney, or some accountants do this for you, or they'll file the setup for you. You're gonna have to pay them a little bit, but they'll do it right, and you won't. And it costs $150 to file your articles of organization, or incorporation in this case, articles of incorporation. You can do it faster for $250.
It's not that much faster.
And then you have an annual filing fee of $75. Well, so remember when I said usually when you start in real estate, you start as a sole proprietor, because there are costs to maintaining an S corporation.
Right.
So at a low level of profit, it doesn't make sense. But when you start making good money, the benefits outweigh the costs.
For sure.
Yeah. So this is a summary of the S corp. Anyone have any questions on the S corp?
Expound on when you say it's easier to borrow money under the business than the LLC.
It can be,
Example.
meaning establishing business credit. Your corporation can be easier to obtain credit for than an LLC. Again, because you have this more official corporate structure and things like that. I think honestly,
That they recognize.
yeah, I think it probably pertains more to larger ventures than what we're talking about, but you know, it's one of the things that you'll see about that. All right, ready to move on?
Yes.
Next thing up, LLC. LLC also has theoretical liability protection. It is simpler to establish and operate from an S corp because you don't have the corporate compliance stuff. An LLC is not a corporation. It stands for company, limited liability company is what it stands for. So you just need an operating agreement. You don't need the articles of incorporation. You don't need the board and the board meetings and the directors. Okay. If it's a sole member LLC, you don't even need a separate tax return because for taxes, it doesn't exist. Sole member LLC is a disregarded entity. It's not a person. LLCs are best when you've got multiple members and you're not going to allocate distributions evenly, meaning like let's say you've got these three people that put in a lot of money, but they're more like silent partners, and this person who maybe didn't put in a lot of money, but does a lot of the work. And when the money comes in, the person that didn't put in a lot of money, but did a lot of work is going to get a bigger chunk than the money they put in. That's an uneven distribution. LLCs, it's very easy to do that. With corporations, through some of the protocol and what have you, it's just, it's harder to do that. LLC is very flexible with multi-member ventures. So when you think about big, construction projects and joint ventures, and when there's all these different people and entities involved, it's pretty much always an LLC. It's also good for passive income because the purpose of an S corp is to minimize self-employment tax. But passive income does not incur self-employment tax. So, rental revenue, it does, you don't get self-employment tax on that. So you don't need the S corp. You may as well go with the simpler and less expensive option of the LLC. So, my brokerage business operates in an S corp. My rental properties are held in an LLC for those reasons. Cons are, there's no tax benefits unless you make it an LLC taxed as an S corp.
Can you say that part about what you just said, with the two that you have?
I operate my brokerage business in an S corp because that's active income, and my goal there is to minimize self-employment tax. That's what S corp's for. That's why I did it. Now, my rental properties are an LLC. I don't need them to be an S corp, and I don't want them in the same entity as my brokerage business. That's a different business. With the LLCs being simpler to maintain, and I'm not trying to avoid self-employment tax, I just put an LLC. You can also own your investment properties in a trust, so that financing is easier, but that's a different class. That's module 3. So the cons of the LLC are you don't have any tax benefits unless you opt to make it taxed as an S corp. If you do that, then you do have to file a tax return. So they came up with this thing a little while ago where you have an LLC, but they go, well, let's make it a separate entity the same way that an S corp is. So you can do that. It's an LLC with an S election. Still recommend you could complete the setup through an attorney or someone qualified to do that. And the filing fees now are the same. They used to be different, but actually the filing fee is the same now. So that's an LLC. Any questions there?
No.
All right. So those are the different entities. Now we have to sort of put pause on that and go talk about self-employment tax so we can go back to the business entity conversation. Self-employment tax starts with what is FICA tax. Who's heard that term, FICA tax? You know what that means? It doesn't matter, you can pay it, right? It stands for Federal Insurance Contributions Act. We call it payroll tax. You've also heard the term payroll tax. That is the same thing as FICA tax. It's Social Security and Medicare. All right, so that's what those charges or those taxes pay for. If the thing is going to fold, let's just fold it and stop paying it, but we'll see. They say we got about 10 years left in it before it's gone. We don't have a choice, so whatever, right? When you have a W-2 job, the total of the FICA taxes that are paid on your salary, it totals up to 15.3% of your gross pay. But here's how it's structured. You're going to pay half out of your money. They're going to withhold, they're going to charge 7.65% of your salary, and it'll be on your pay stub as Social Security, Medicare, two different line items, and they'll total up to 7.65% of your money. And your employer, not on your pay stub, but back on their end when they file their stuff, they have also paid 7.65% of your salary.
And if you have assistance through the market center, you learn this.
Well, it's not about being through the market center. It's if you're paying them via payroll.
Because I was like, why are my fees so high? And they're like, you're paying their taxes.
Well, they're an employee.
Paying their taxes. Well, you're paying the employer portion of their taxes.
Yeah, and again, it's not to do with them being paid by the market center. If you're paying them through payroll directly, it's the same amount. There's no way out of this. Death and taxes, right? This is the taxes part. We won't be covering the deaths today.
That's later.
But it totals those two numbers total 15.3%. Self-employment tax means I just went out and opened my lemonade stand or my real estate business. And sometimes lemonade seems attractive though. So you don't have payroll, right? When you're running the lemonade stand, there's no payroll. I'm not running payroll through paychecks or, whatever, right? You still pay the money and it's the same amount, except you pay it all. It's 15.3% of your self-employment earnings. And we call it self-employment tax. It's FICA tax repackaged. You're going to pay it either way. This is a secret tax in the sense that a lot of people don't realize they're paying it. But if you don't have a business entity like an S Corp or an LLC with an S election, you are paying that. And if your tax bill is bigger than you thought it was going to be, that might have something to do with it, because you're not accounting for that when you're taking in your sole proprietor income. People aren't thinking about that, and it adds up pretty quickly. I mean, if that's $100,000, that's $15,000. A lot of money. A lot of agents get trapped here in that spiral. Even if they accurately projected their federal and state tax, there's 15 grand. A lot of money. So that's self-employment tax. Half of it's deductible. When you're an employee and they withhold 7.65% of your pay, you still pay taxes on that. When you get your W-2 and it says like your Social Security wages and then your full wages or whatever, like you're still taxed on that money even though you didn't get it. Not my rules. So when you're self-employed, for the employer can deduct that's payroll tax, right? That's a deductible expense for business. So when you're paying a self-employment tax, you can deduct half of it and not the other half. It's apples to apples, exactly the same.
Okay,
Yes.
so my hard understanding of trying to understand the self-employment tax,
Mhm.
because I was just so happy to finally be at the place of business to say, hey, I'm on payroll.
Yes.
And I'm taking my salary and I know what my budget is for the
Mhm.
household. I know what I want to bring to mom. I'm like, Angie, why is it that as much money as I'm taking to call myself just, this is my salary? Then you send me this payroll tax bill. She's like, Nakia, I didn't realize that, okay, now I'm a business owner, but now I'm also the employee.
Uh-huh.
But now on the employee side of things, I get a W-2.
Mhm.
I didn't realize that.
Yeah.
But so it kind of, and I'm like, that's just so crazy to me. I'm paying, I'm doing the salary, I'm prepaying taxes to then get it back.
Right.
On that
Because you're
side.
looking at it going, well, I used to just get my money and use it. And now I'm running my money through this other place where
Yep.
then I'm paying tax on the money that I'm taking for myself. Why?
Right.
Because it's less than doing it the other way. It's just the other way. It wasn't hitting you until tax time.
Yeah.
And then you were getting on that payment plan,
Yeah.
right?
Yeah.
It's actually less money. It's less money that
So
you're
you
paying.
mean to tell me that when I file taxes this coming around and I prepaid all of these,
Yes,
my tax bill should look different?
it will. It will. And we're gonna walk through some examples on
Wait,
it.
is it double different, like first?
Well, I can't tell you about yours. I don't
I
know.
know you're not.
I don't know. I don't know.
I like that.
No, really just meaning
Make me feel good,
it'll
please.
not even.
Comfort.
That on the W-2 side. On the W-2 side. It's not like you say, do I have to now file to ask for a tax refund, or is it kind of like whatever that refund is, now you can go ahead and just apply it to what you're gonna owe in the business?
Well, understand right now, we're not even talking about income tax. We're talking about FICA tax.
Oh, okay.
But you pay this no matter what.
Yeah.
Okay.
No matter what, whether you work a job or you're self-employed with no business entity, or you're gonna pay FICA tax,
Got it.
period.
Okay.
With an S corp, when you take a salary, but then you also have profit, you're only paying the FICA tax on the salary. That's a smaller amount than the
And a big
profit,
amount.
and that's how you minimize the FICA tax. Because instead of paying 15.3% of $100,000, you may pay yourself a salary of 30 or 40,
Mhm,
and you pay FICA tax on that, but
mhm.
not on the rest of the profit.
Got it.
I heard that.
Okay,
And we're gonna go through those
That part's
numbers.
clear.
tell me if I'm moving too far. But my question behind payroll and stipend. There is.
We're gonna go there. We'll go there.
Okay.
All right. Let's go through some examples so we can make it concrete for you. So let's say you earn $100,000 salary as an employee at a job. And you're gonna have $76.50 withheld from your paycheck as FICA tax. It'll be on your pay stub as Social Security and Medicare. You'll actually get $92,350 prior to talking about whatever income tax withholdings, right? We're just talking about FICA tax right now. Yep. Actually, this is wrong. That's why I put the disclaimer. Your taxable income is still 100 because that's not deductible.
Yeah, because, right, that's to be paid on
When
top
you,
of it.
on the employer side deductibles, that's wrong. Don't look at that one. Your employer actually paid 107,650 because they paid you your 100 and they paid 76.50 straight to the feds for that, right? So he got his money. Uncle Sam got his money. He always will. He'll get his money. Got 15.3. If you're self-employed and you made that same 100, but you made it for yourself instead of working for someone else, you're going to pay 15.3. That means you're only going to keep 84.7. Uncle Sam still got his 15.3. He always will. Half that tax is deductible. So your taxable income is 92,350. It's actually a little bit less than here because here your taxable income is actually 100. So it's a little different than getting it as, you know, as an employee. The difference comes into play when you own the business, and that's where we're going next. So remember, S corps are people too, and so they are a separate entity. When you have an S corp or an LLC taxed as an S corp, you personally are an employee of the business. Remember, the business is not you anymore. The business is a thing, and you work for the business as an employee. You also separately are the owner of the business. So then the business has to pay its employee a salary via payroll with some income tax withholding. That's the other thing, the key is that you're paying yourself a salary. You're also prepaying some of that income tax, so the bill won't be as big at the end of the year either. Okay. Now the salary, this is the key to the S corp. The salary is not going to be the whole amount of profit. If you clear $100,000 profit, you're not going to pay yourself a $100,000 salary. That invalidates the entire reason of having it. The point is that your salary will only be a portion of the net profit. The rest of it, you would call either retained earnings if it stays in the business, or if you pulled it out, a distribution. So Nikia, you were asking about, hey, you know, when I'm taking my money to live on, right, you could take the full amount you need to live on as a salary through payroll. Or if you're trying to minimize the amount of the salary, you could take some of what you need to live on as through payroll, and some you just transfer from corporate account to personal account.
That's what you call a
Right.
stipend?
You could call it that.
Distribution.
You could call it whatever. Yeah, distribution. It's technically a distribution. Now the thing is, some people work with accountants who will tell them that they can run all their money through an S corp and not take a salary. That, if you're the IRS, and you're like, well, let's see, we have a profitable business with 0 employees. Tell me more about how that works, right? So yeah, you're not supposed to do that. And you're probably raising your hand for an audit if you're operating an S corp that has profit and no employees. You got to take some. I'm using in these examples, I'm using a 50-50. 50% profit, 50% salary, and 50% distribution or profit. That's a recommended balance. It doesn't have to be exactly that. And I'll tell you straight up, mine reason has not been exactly that. My salary has been lower than 50%, but you can only push it so far before you start looking like ripe. Right? No, you do not. So remember, your salary is going to hit your personal account after you pay your little taxes on it. And then your distributions, which are going to initially be in your profit, is going to be in your corporate account. And you can take some, I don't recommend you take all, but you could if you wanted to. You can take whatever that money you want or need as distributions of profit. All that money ends up being taxed on your personal tax return. Your salary is your personal income, and the business profit as the owner, you get a K-1, and that goes on your personal tax return too. It's all only taxed once in terms of income tax on your personal return. This is how self-employment tax works with an S corp. We're going to go and do some numbers so you can see what difference it makes. Okay. We good? We following?
Yes.
Ish enough?
Ish enough.
Okay.
Right.
So we're gonna keep using the same numbers and hope the consistency helps us to, grab onto the concepts. $100,000 of business profit. $50,000 salary, and the rest of 50 is profit. So how much FICA tax would you pay? Nakia, this is for you. You have a $50,000 salary, the employer, the business is gonna pay that amount. The employee is gonna have that amount withheld. Therefore, the total FICA tax paid is $76.50. Remember what it was before? It was 15.3% on your full $100,000 profit as a sole
And
proprietor.
not on 50.
Mhm. And that means Uncle Sam only gets half. Keep the other half. So your taxable income as the employee, or again, this is wrong. I was supposed to correct that. I didn't. As the
That's
employee,
okay.
your taxable income is 50. As an employer, you have that deductible payroll tax. So as the employer, the profit was your 50,000 profit minus that payroll tax,
Now
46.
it goes 46.
So it's, it's like 90, should be 96,175, right? The point is, you paid half in FICA taxes compared to if you operated the same business without a corporation.
So that can be done under an LLC.
An LLC taxed as an S corp.
LLC.
That's exact.
Yes.
Now,
And so if you have an existing LLC that is not taxed as an S corp, it's a disregarded entity, you can change it and say, we want to file the S election. You're going to have to probably file something with the Secretary of State and something with the feds, and you go, now it's taxed as an S corp. Now it files a separate tax return. Now you can do all that.
so if you have an LLC in place, then you can add that.
You can
Yes.
change it on,
You can
change it.
on Cyber Drive, and you go in and you'll have a CPA to modify and change. It's just that you're changing the way that you do business, and you can elect that.
Yep.
So if you're
And
gonna
leave it
do
on the
from,
IRS site. I'm sorry.
I'm sorry, I interrupted you.
No.
I apologize.
No, it's all right.
So if you're starting from the ground zero, you want to have it an LLC as an S elective.
Maybe.
I think for a profitable real estate business, you want to either have an S corporation or an LLC with an S election.
S election.
Yeah. That's, you want to have one of those two. Otherwise, there's no benefit.
There's
Those are
no
the only
point.
two that have a tax benefit. And so Nakia just walked out. You say, how much money did you save? You saved $7,650.
Which is
Got it.
good.
So Mike,
Sure,
Yes, I'm sure.
because you're also the employer, so you still end up paying that tax, right?
What tax?
She's saying if you the business entity, so the other person in is you. So she's saying that you still, as an employee, still have to pay the FICA tax. So how is it?
But
that
your
you pay that?
FICA tax only was $7,650 instead of $15,300.
Right,
Yeah.
Because
Right,
you're
I hear
profit.
what you're saying,
and it's only,
but you're still the employer, so you're your business. entity.
We already covered that though.
Yeah, but
This is your business end. You don't pay any FICA or self-employment tax on the other $50,000 profit,
Right, it's only on
That's
half
the
of it.
only on your salary.
only on the salary portion. That's why some people abuse it and say, well, I'm not gonna pay myself a salary at all. I'm gonna take the whole 100,000 as profit and not pay any FICA tax.
Yeah.
I wish you luck. You see
Yeah.
how many years you can do that before you end up making good friends with Uncle. Yes.
So can you say that I was paying more taxes when I was not taking a salary? Not really, so it's just, I guess, the way of thinking
It's
about
the
it.
entity
it's-
that's separated than
Well, when I paid myself, now paying myself a salary, not understanding the whole concept at first of why these extra,
Yeah.
things, why am I paying payroll
Yeah.
taxes, why, but now I'm understanding it a little different. It's almost like, you're prepaying taxes that now can't be taxed against you on a portion of the money that was collected out of what total income that has.
What you're doing is you're paying $76.50 now instead of paying $15,300 later.
Is it? Okay, I get it. I get it.
That's a good deal. We call that a good deal.
Call it, I call it.
Yeah,
That's it.
I think my head won't be as hurting.
Yeah, mine is.
So here's how it looks. Here you pay, so same numbers from the same slide. You know, here you have 84,700, under this, you have 92,350, you save 70. So now, if your numbers look different, if your net profit's higher, or your salary and profit split is a little different, then these numbers can fluctuate. They can look a little bit bigger, a little bit smaller. Point is, having S corp saves you thousands of dollars in FICA tax. That's what it does.
My conversation is gonna be like, hey, Angie, I want to set up that S thing so that I get the other thing and then I don't
Right.
have to pay the double thing.
Yeah.
You know?
So again, this is just so you know the questions to ask. Now, if you've got an accountant that you've gone to help minimize your taxes and you don't have a business entity, and you want to know why they didn't tell you about this, that would be a good question. That'd be a good question to ask.
You're really
Do you have a question on the Zoom?
I just want to go over there. Today? Yes.
Oh,
If
yes.
he pick you up. Okay.
Got some chatter on
There we
the
go.
line, in the line.
Now remember, we didn't get into income tax yet. That's a separate thing. So we're just talking about FICA tax. S corp minimizes FICA tax. And you'll save 7-8 grand, something like that. So it's
like
good.
that part.
It's good.
That's clear.
All right.
That's pretty clear.
What do you think? What do you like for you?
Shit, the damn S corp.
I like the S thing.
I got both, but.
Either one.
I have the S corp for commission and LLC for commission.
Yep.
Yeah.
There you go.
Say that one more time.
S corp for your
commissions.
business, for commissions, yeah.
They both together.
LLC for your passive income.
Let's try again.
For your property.
Yeah. for
Yeah,
your
if you need it.
income.
Now, you wouldn't need an LLC for something like profit share income because there's no liability in that business. There's
So
no
I should
reason
say
to have a
rental.
corporate entity or a business.
Rental or Airbnb.
Yeah, exactly. That's what an LLC is good
Hey,
for.
boo.
All right. Deep breath, shake it out. We got a business entity. We know about FICA tax. We know about income tax breaks.
Still.
All right.
Heart's still there.
All right.
Yeah, okay, we didn't.
We did it.
Any final ahas on the business entity portion before we move forward?
Alex, can I ask a question?
Go ahead, shoot.
So if you do a S corp, is that the one where you can also do a, with, like you pay yourself a salary, but can you also do the distribution on the S corp only?
You can do that with an LLC as well.
But what if you just do an S corp?
You're saying if you have an S corp, can you take distributions in addition to your salary?
Correct.
Yes.
Okay, that's it. Okay.
Yep.
Thank you.
Any other ahas on that one? On the
Uh,
business entity selection?
We're like.
I know some people, and it's not uncommon, kind of the key what you mentioned. You've taken advice from someone that's been good advice about what to get, but you didn't maybe understand why.
Yeah.
And at some point, I think it's beneficial to know, like, what is that? Why do I have that? Because now you know it really is the right thing, right?
And I'm really glad, like, this has been many years I was told to do that, and I'm
Yeah.
like, I don't get it.
Yeah.
I didn't get it.
Me too.
Yeah.
Me too.
Well, this is the first time in my life that I've ever had anyone explain it.
Exactly.
Like in my.
So, and I thank you for that because I'm like,
Mhm.
and I wasn't gonna pull the trigger just because somebody else
Right.
said so.
Right.
Right, and that's what we're all doing. We're all
Right.
pulling triggers because like, well, 5 people all said the same thing. I guess I'll
Right.
do that.
Right,
Right.
I do it because Alex tells me to.
well, that's
Well,
what we have Alex now.
At the end of the day, you can take advice from people you trust. The problem comes into play where like, oh, I've had this accountant for 13 years. I trust this accountant, but the accountant didn't tell you this.
Yeah.
Or he didn't.
Or, I'm sorry,
But you know what, or
you feel like a pilot without a map.
Right.
Yeah.
you
And that's
are,
how I feel. I'm a pilot. Where's the map?
Mhm.
Yeah.
Yeah.
Mhm.
right, no
I kinda like it
roadmap.
that way too.
Snoopy in the red
We're going that way.
Yeah, first of all, this is not universal language, and so I
No.
just think
Right.
we're truly blessed that we're in the position to receive and have someone who understands it,
Mhm.
mirrors it, and, and actually share it.
Mhm.
Cause all of those three are important, cause you can have the other two and they won't share shit with you.
I got it going on. And I'm not gonna tell you why I got it going on
Right.
or how I got there.
Right,
I'm it, you're not,
right,
stay there.
that's it,
Mhm.
absolutely.
Alex,
Yes.
Hi, this is Donna Crane.
Hey, Don.
How are you doing?
Great, you?
Okay, good. I'm glad I'm on because I didn't know that you can have an LLC tax as an S corp. I thought I would have to restructure the whole thing, and I didn't. I have an LLC, and I wanted to change it to an S corp, but now I know I don't have to go through a whole bunch of rigmarole.
Yeah.
I can just
no,
do just
a couple
a few
simple
things.
documents and you're done.
I think that's awesome. That's my biggest aha. That's
Great.
huge.
Thank you for sharing that. Patricia,
This is not an aha, but it's a, I was just get the question.
is it a ha?
Yeah, I was gonna say so stupid, you know. So so the question would be, okay, this is October. Now we done learned all this stuff, right? Just talking from other seats. What could you do today to change it for it to be effective for this tax year?
You could talk to your accountant about that.
That's what I thought. That means that you can make it happen still.
And you could see where your accountant,
Yeah.
how, you could see where your accountant believes that line is and how
Right.
close they want to walk to it
Mhm.
in terms of when you set up an entity and when the income was passed through it.
Yeah. And that's only different, and it's custom depending on what else you got going on.
It's how willing your accountant is to toe the line
Yeah.
and defend you in an audit if it happens. Because the thing is, like, a lot of times we think about IRS stuff as it's cut and dried. Guys, it's not.
It's
Like,
not.
There's
It's
a lot of things.
circumstances
There's
that you
not
can modify.
one answer. It's like,
Yes, absolutely.
well, where do you want, is it here or here? I don't know. Like, there isn't a clear defined answer for a lot of things.
What you
And
just said
they
is
were-
huge. Sorry, I didn't mean to
No,
interrupt
you're
you.
good.
I just love what you said, because that is a good measurement of this professional you're employing. Not in a weird way, but like, are they prepared? Are they clear enough in what we're doing to defend me in an audit? Because my brother-in-law, who owns his own business, has been through a few.
Yeah.
And his accountant, I think, has done pretty well by him, but I watched that happen, and it really was, like you said, I was shocked at what a negotiation it was. I thought, uh-oh, IRS goes in and it's over. And no, he was like, well, prove this. Well, I did. So now why do you still get? And it went back and forth
Yeah.
for quite a while.
Yeah, it doesn't sound awesome, but yeah, to me, and this is just a thinking or a behavioral thing for me, is like in what I do, you know, in my real estate business, for example, I know exactly where the line is. So I'm willing to walk right up to the edge of it, and I
Me
know I'm
too.
not crossing it.
That's
That's why,
exactly
Robin, how many
right.
calls did you get about me?
No. How many you get about me? No, thank you.
Because you know where the line is, and you can walk up to it. Now, if I don't know where the line is, you know, I'm either being reckless by venturing into that territory, or I have to be super conservative, and I can't approach it.
Absolutely.
So, you know, that's just, and I like my professionals to be like that. I want to know that you know exactly where that line is, because then we can get all the mileage we can out of it.
Yeah. And he said mileage. Don't forget to write that off.
That's right. Back to mileage. Mhm. All right, let's roll. I'll keep you a little bit after 5. We probably still won't get through everything, but there is so much cool stuff in here. I'm gonna go till the bell rings, okay? We're gonna talk about retirement accounts,
That's what I want.
other trust accounts, and we're gonna touch on self-directed accounts. This information is very summary in nature. There are a lot of ins and outs to all this stuff, but you can keep a lot of your money by taking advantage of this. These are 2 great websites. The IRS website on retirement plans is actually not super esoteric. Like it's legible. You can go and read it and it makes sense. And there's a great series of summaries on the Kiplinger website about these different plans. They go in a little bit more detail about them. Okay. Always get personalized advice from a tax professional, because there's income phase outs, there's disqualifications. If you have this, you can't have that. There's a lot of ins and outs to this stuff. Let's get rolling. What are retirement accounts? That's a trust account. It's a different person, right? Corporations are people too. Retirement plans are people too. Trust account, you're the beneficiary, and it has special tax advantages. What makes it specifically a retirement account is that those tax advantages are either in whole or in part achieved based on age. Okay, so in most cases, when you take money out of them after you turn 59 and a half is where you get those advantages. That's what makes it a retirement account and not one of the other ones, okay? And they typically have required minimum distributions at age 72, meaning once you turn 72, you have to be taking certain percentages of money out of it every year. So that's what kind of makes it a retirement account. What tax advantages do they have? Usually it's one of two things. Either the contributions are deductible, meaning when you put money in, you can reduce your taxable income that year by that amount of money, or the distributions are untaxed, meaning when you take money out, no tax comes out of it.
That's after you're 59.5.
It's one or the other, right? So you're either going to have deductible contributions or untaxed distributions, not both.
Right, but your point is after 59.5. Yeah.
In most cases, yes. Asterisk.
Not 3/4.
So with the deductible, remember we talked about deductions and credits and stuff, right? If I drop money, if I drop 5K into a retirement account in the type that where the contributions are deductible, it reduces my taxable income by 5K. I keep the whole $5,000 and I don't pay tax on it. So remember we were talking about your effective income tax rate? This is how you can reduce it. Now, you can't play with that money. You can't buy organic groceries with it, but you can keep it in your retirement account. You should be saving for retirement anyway.
Did you say organic groceries?
Yeah. It costs a lot of money.
It sure does. A lot
Yeah,
of-
this is a thing for you.
Yeah, yeah.
Wow.
So again, either your contributions will be deductible or your distributions won't be taxed, but not both. You're going to pay tax on money when you mess with retirement accounts, but you only pay it once, either on the way in or on the way out.
On the way out.
But you can pay tax once on it, not twice, as would be the case if this was a taxable investment account at at Charles Schwab or something. You're putting in taxed money, and when you take out gains, those are taxed too. And the growth is always tax deferred. So inside of a retirement account, if there's trades happening and stuff like that, you're not paying taxes on those trades. The value is accumulating, the growth is accumulating. You're not being taxed on that every year as you would if it was in a taxable brokerage account. Right? So those are the general tax advantages. We got to sidestep for a second because as you start to think about what retirement plan might work for you, you're going to need to think about a decision as to whether your business is going to have employees. Now, in the real estate business, when employees end up being, if you're building a team, and there's two types of people you get out on your team, there's salespeople and there's operations or administrative people. Salespeople are basically never going to be an employee of yours. They're an independent contractor of the office. Administrative people you can employ, where like I go and hire a payroll service and they cut payroll to my unlicensed assistant. You can do that. Then you have an employee. But if that assistant is licensed, Illinois license law says you can't pay them on payroll. The brokerage has to pay them on payroll, which makes that person not an employee of your business. They're an employee of the office. And they are what's called a leased employee to you. You're leasing that employee from the office. So that's on paper how that
You
works.
still can fire them.
Right. So a decision that I made early on is that in order for simplicity, in order to take advantage of some of this stuff, I knew that at various times I'm going to have probably both licensed and unlicensed employees. And I don't want to treat them differently for the purposes of compensation benefits and stuff. I mean, you might earn different pay amounts, but when we start talking about some of these retirement plans, there are requirements. If you have employees with a lot of these, there's certain things you must do. And if I have someone that's my employee because they're unlicensed, but I have another person that can't be my employee, they have to be employed by the office because they're licensed, I can't give that person the same benefits. So I said, forget it. I'm going to have no employees. And any person that I have that's an employee, it will not be in my business. They're going to be on the market center payroll, even if they're unlicensed. That way I can make my planning decisions around everyone's going to be in the same category. And my business has only one employee, and that's me. Okay. That was my decision. If you want to go with a different decision, you say I'm going to have employees, just know that it's going to get a little complicated with the retirement plans because they have required treatment of people because they don't want employers taking advantage of employees and treating them differently. But some of these people, because of Illinois license law and the business you're in, they won't actually be your employee. So to me, it was simpler to say, do I intend to have direct employees? No. All my employees are going to be leased employees. And It just allows me to have the cleanest setup moving forward and
You don't have to
treat all
worry about-
employees the same.
Mhm.
All right,
Equal employment opportunity.
there you go.
Yeah.
So that's my decision, and I think it's the best one for the industry that we're in, and the things that we're going to talk about. But you get to make your decision. Okay. So let's talk about what these common retirement accounts are. IRA, SEP, simple, 401k. You heard of these?
Yeah.
Nothing crazy. That's what they are. IRA is the simplest. Anybody can have one. It stands for an individual retirement account. Anybody with earned income can have one because you have to have earned income in order to contribute to it. With an IRA, your contributions are deductible, and then your withdrawals are taxed after retirement age, right? So if I drop $5,000 in, it reduces my income tax liability today. It reduces my income by $5,000. When I'm 59 and a half and I pull that money out, it'll be taxed as income at that time. If I try to pull out before that, there's penalties, right? But if I pull it out at retirement age, it's taxed at whatever bracket I'm at and whatever tax rates are at that time. Right now, the maximum contribution is $6,000 per year for an IRA. So if you make at least $6,000, you can put $6,000 into one and get a deduction of $6,000. And you can have more than one. You could have 2, 3, 5, 16 different IRAs, but it's 6,000 total combined per year. Okay. There's a catch-up provision that'll boost you up to 7,000 if you're 50 or older. So like that's called a catch-up provision. Yep. They don't have a mustard provision yet.
I was gonna ask what about relish?
In Chicago, we gotta have a tomato. We gotta have a
You know.
sport pickle or a sport pepper.
And a pickle spear.
Mhm. And there are income limits to IRAs. So if the benefits phase out at a certain point where like when your income gets well into the hundreds and stuff, you could put money in, but you might not get deduction for it. Okay, so there's some limitations around income with them.
So what's your personal feel on IRAs versus IRA accounts, $6,000 a year max contribution towards retirement versus investment?
You probably have all of them.
If you, well,
Now, nothing. Yes, you do.
He said for the sake of time.
when I look back at the stuff I've put money into, the amount of money I've put into real estate and what it's turned into, and the amount of money I've put into financial brokerage accounts through retirement accounts and what that's turned into, if I had to do over again, I'd have probably allocated half of what I put into brokerage accounts into more real estate.
Yeah.
Over time, it just makes way more money. So we'll talk about more about that in module 3.
Make more and more sense.
Yeah.
Yeah.
Especially for those of us that are in the business, right? So yeah, their phase out begins at 125 when the phase out meaning where it begins to not be deductible. There are some restrictions if you have an employer sponsored retirement plan. So, if you work at GE and they have a 401k, or you have you're a teacher and you have a pension, you might not be able to open up an IRA. So you got to check.
We started, custodial IRA accounts for the kids.
Yep. Yeah. Oh, there's so much weird, cool stuff you can do. You can have your children do work for your business, pay them earned income, then you put money into a Roth IRA and you let it grow for 60 years. And then when they take it out, it's not taxed. I mean, there's just some ridiculous stuff you can do. A Roth IRA is an IRA, but the contributions work backwards, or the tax benefits work backwards. So it's the same limits, it's the same policies, it's all the same stuff, except instead of you getting a deduction when you put money in, you're gonna put money in that's taxed money, meaning you're not getting a deduction for it. But then it grows in the account, and when you take it out, it's not taxed when you take it out. So it's backwards from the deductible benefits of the IRA. So why does that, so what's the application of that? Like, why would a Roth make more sense for one person versus a traditional IRA for another?
I'm thinking there's no income limit on that one, right?
There's all the same stuff. There's income limits, right?
Where you are in your life.
Yeah, that's one thing, is the further away from retirement age you are, right? A child with earned income can open an IRA. If the child's 10 years old, and they did some passed out some flyers for your real estate business. They posted the model for your flyer, for your advertising, whatever. They had earned income. And you go and drop $6,000 in there for a 10-year-old. In 49.5 years, that money has grown for 50 years. The value of that money having been invested for that long will be absurd. And they'll take it out and not pay any tax on it. So the farther away you are from retirement age, the more beneficial a Roth IRA might look. Also, if you believe that your tax rate in retirement will be a lot higher than it is now, because then taking it out untaxed at that point is more valuable. Those are two reasons that a Roth IRA might make more sense, is if you're far away from retirement age, or if you're really confident that your income tax bracket at retirement age will be a lot higher than it is today. That's kind of a tough one to call if you're really far away, but if you're 10 years away, you might have a better sense of that,
I
right?
have clients who worked several jobs that had pensions, and combined, they make more in retirement than they did work.
Yeah, and they're getting crushed on taxes. So if they had a Roth IRA, well, of course, if they have pensions, they may not have been allowed to contribute to a Roth IRA. But talk to your tax advisor. So the cool thing, one cool thing about these is that you can have a spousal IRA, meaning a spouse that doesn't have earned income can create and fund their own IRA because you have one and fund one. So you can double up. Kind of cool, right?
Yeah.
Because these are, in the context of the plans we're going to look at, these are very low contribution limits. You can't put away a lot. That's the disadvantage of IRAs. You can't put away a lot of money on them. But you can double up on them with the spouse. And they have all the same contribution limits and all that stuff.
This is Wendy. Can I ask a quick question?
Go ahead.
The limit of $6,000, is it across your Roth and your regular IRA? Is that combined 6,000? Okay,
Combined total of all IRAs. Yep.
got it. Thank you.
Good question. The only way you can put in more than 6 is if you're over 50 or you do the spousal IRA. Any other questions on IRAs?
And you can put it in up to April of the tax year.
Yeah, I didn't get into that, but you can file IRA contributions with your tax return, as opposed to other things like a 401k has to be done via payroll. That's got to be done via payroll during the tax period in question. That is one benefit of those. Yeah, I didn't put that on there. That's why I can't put everything on it, but you're right. That is true. You can file it with your tax return. Yep. Yep. All right, let's roll. Next, SEP IRA. SEP is a type of an IRA. It stands for Simplified Employee Pension. Same as your traditional IRA, your contributions are deductible. So you get a deduction when you put money in, and then it's taxed as normal coming out at retirement age. The benefit of this is because it's a higher contribution limit than an IRA. So it works a little different. You either can put in 25% of your adjusted net earnings, and they have a little formula for that. 25% of your adjusted net earnings, or 58,000, whichever is less. So in order for the 25% to be 58, you'd have to have adjusted net earnings of $200,000. Right? So if your net profit's 100, you can contribute 18,587. That's not 25%. That's why there's an asterisk that says adjusted. Don't ask me to do the math. They have some stuff. It's some math. That's just how the numbers work. Okay, we go with that. You can have it if you're self-employed, so you don't need a business entity, or if you do have a business entity. Okay, so any sole proprietor or whatever you have, you could open a SEP IRA. One of the benefits is that compared to a full 401k, the costs are very low for all IRAs. The administration costs to open them and the annual fees and stuff, they're very low cost. The cons of this are only the employer can contribute. So the employee cannot contribute. And that is some of the other plans, it's not that way, which means you can put in more money. When it comes to having those employees, you have to contribute the same amount for all eligible employees that you contribute to yourself.
So that's the thing, you gotta be equal, that's why you were saying the plan.
That's why I said I'm not gonna have employees, because what if I have 2 operations staff, one's unlicensed, one's licensed. The licensed one is not my employee and cannot be a part of my SEP IRA.
But you can't set the.
So how can I contribute if I wanted to, you know, I can't do that. So,
Thank you for that.
it keeps it simpler when you do it that way, but yeah, that's one of the cons of the SEP IRAs. The requirement is you give the same to everybody as you give to yourself. Okay? That's a SEP IRA. You good?
Yeah.
Let's keep rolling. Simple, also another kind of IRA, stands for Savings Incentive Match Plan for Employees. All right? Yeah, and ironically, the name is the least simple. They even did that thing where the acronym didn't quite work, so they did the PL from the one word, you know, it wasn't just this letter. Were you clapping for that? That was great. Same deal as the other traditional IRAs. Contributions are deductible, withdrawals are taxed as normal income. The pros of the simple IRA is that it has higher contribution limits than the traditional IRA. It's 13.5 per year. And the catch up will get you an extra 3K.
All right, Master.
All right. Yeah. If you know how these things are built, Patricia, they get better as we keep going through. And we keep getting the best. We say the best stuff for last. Okay.
Yeah.
So you got basically, you know, more than double the contribution limits of traditional IRA. You can have it if you're self-employed as a sole proprietor. You can have it if you have a business entity. And just like the other types of IRAs, the administration fees are low. On the downside, they're more towards providing value to employees, not necessarily to the owner. You want to provide value to your employees, but you can also do that through other ways that don't have to be the entire retirement plan. This can get to be kind of limiting when you look at some of the other options. The contribution limits can be lower than the SEP IRA depending on what your net earnings are. But if you remember, it was like 18 something on a net profit of 100. And this is limited to 13.5. So the contribution limits are a little bit lower. You have to contribute to all eligible employees, and you have to either do a dollar for dollar match of their contributions up to 3% of their pay, or you have to pay them all 2% of their pay, regardless of what they contribute. Again, this is why I said I'm not going to have direct employees, because if they can't all be in the same category, I can't give one of them this and the other one not. So, so it's a restriction. And now you're going back to that slide and going, yeah, I see what you're talking about with the leased employees thing, right? That's a simple IRA. You know, could be a decent option. Any questions on that one? Here's a 401k. Same as the IRAs, your contributions are deductible and your withdrawals are taxed as income. The employee contribution limit is 19.5. That's the highest limit we've seen yet, right? That's just for the employee. Remember, this assumes you're paying yourself a salary. You need to be doing that in order to have a 401k. If you're 50 plus, you can sock in another $6,500. So you can up the employee side contribution to $26,000 a year. But that's not all. The employer, and because you work for a kind and gentle, loving person, your employer can also contribute up to 25% of whatever your salary was. And those combined contributions just can't exceed 58 grand. So the downsides of 401k is you have to have that business entity. You can't set this up as a sole proprietor. You got to have an S corp or an LLC taxed as an S corp. It's got to be a separate person. Corporations are people too. You have to be paying yourself a salary. You got to have payroll, because 401k contributions have to be done via payroll deduction. And for a full 401k, foreshadowing, the setup and administration costs are high. I originally started with a full 401k, and I ended up, they jacked up all the fees, and it was thousands a year. And I was like, doesn't make any sense. And I had to make this. I had it at that point because I wanted to be able to provide that for my employees. And then I had to confront the reality that I was going to have employees that were direct and employees that were leased, and I couldn't do the same for all of them anyway. And so I got bailed from the 401k and I went to a solo K. We're gonna go there in a second. But for a full 401k, the fees are very high. They're built for larger employers. And the full 401k also has what they call non-discrimination testing. It just means that you have to contribute evenly to all employees or not contribute to any of them, or you have to match contributions. Same restrictions as the other stuff where it's like, hey, you have to meet some requirements. You can't just pay out whatever you feel like to whoever you feel like, okay? Here's we're gonna do, this is more pro. I had a whole other slide of pros for the 401k, all right? There's such a thing as a solo K, and that's designed for businesses that do not have employees aside from their owners, AKA S Corps like us, right? That's who a solo K is for. It eliminates the complexity expense of the full 401k plan. It eliminates the non-discrimination testing requirement. You just can't have any other employees, right?
Cool.
At least direct employees. And if your spouse wants to work in the business too, you can double up on all of those limits.
No shit.
Oh, yeah.
Without them being an employee.
They have to be an employee. If you employ them, you pay them a salary through payroll. More, you can take all that 19.5 and that 26 and that 58. You can double all of that if you'll make them an employee of the business as well and pay them on payroll.
Yeah.
Finally, a better-
Still under solo though.
Still for it's solo K. It's just you and your spouse, right?
That's right.
Do you pay your wife a salary?
No, she's not. No, not this time. But we could add that anytime if we want. Which means that your employee side contributions could actually be $39,000 a year, and you could contribute up to 25% of both employees' contributions. All told, you could sock away $116,000 by doubling up on that, or if you're 50 or older, $129,000. So the limit to what you can put away in a 401k is just however much you got. It's just however much you got. You can sock away a ton of money. Let's look at an example. If you have a $100,000 profit and you paid yourself 50 in salary and took the other 50 in profit, remember, same example, same numbers. Inside of your 50 salary, you could take 19.5, throw in the 401k. At the end of the year, you could do your generous, lovely employer match of 25% of your $50,000 salary. That's another 12.5. By the way, you didn't pay FICA tax on the 12.5, remember? Yeah. So combined, you can put $32,000 in that account out of that. No? And that all because all of that is deductible contributions that were due. That's a deduction of $32,000 off your income. But wait, there's more. Come on, Alex. It's still going. I promise you, there's more. Okay. Even more pros. You thought I was done with this 401k. You can have a Roth option. And you don't even need to have a separate plan. You can be like, oh, I want this 8,000 to be a regular 401k contribution, but I want this 11,000 to be a Roth contribution in the same account, the same plan.
But it's just separated.
Yep. But some just look at me like, this is like, your head's exploding, right?
I'm not overloaded.
So the law
I got it.
would be.
It's a tax.
They take it out.
Tax, yeah, you pay with taxed money, but it's not taxed when you withdraw
It's
it.
not taxed when you pay.
Yeah.
It's an investment property. That's why I was asking.
It's better than a coffee can on the shelf. Can you agree with that, right?
Oh,
All right.
yes. Or the big water jug.
The water jug, yeah, coins.
This is also mitigating.
Yeah.
That's the thing.
Tax deferred,
Yes.
tax benefit,
This is the stuff that if you want to keep more of your money,
and not give it to the government.
these are the vehicles that allow you to do that. By the way, 401ks have a borrowing option. I borrowed money from my own 401k
Yeah.
for the down payment and rehab of the house that we bought.
Absolutely.
And I pay the money back into my own 401k with interest to myself.
To yourself, yeah, with no
You
penalty.
No penalty.
No penalty.
Because it's your own retirement plan.
You can generally borrow up to half the money in there.
So there's a lot of really great stuff going on here. And the price of admission is understanding it or working with a professional that does.
Yeah, you have to understand enough to know what's there and what to ask about and what to say, hey, tell me about how this works for me. Let's look at the numbers for me.
I think even just now being able to say, hey, I want to really dig in here to what's possible. Like,
Yes.
that alone is a good
Yes.
conversation.
Yep.
Shit, that's a good conversation.
Uh-huh.
Yeah,
As
this
opposed
sounds
to
like.
just-
So, yeah, so on the borrowing, there's no penalty, no tax. In fact, we did 401k loans from both of our, we had 20% down and we had to rehab the whole house. So we did 401k loans from both of our 401ks. We paid hers off, but mine's still out there because I'm socking away all the money via the
Yeah.
contributions for deductible. I'm looking at what I'm paying back to myself. I'm like, I don't even feel like paying it back. Like, I'll just pay the monthly payment. And
Right, well,
You
I'm
know?
gonna pay all of that back to myself.
for what? With after-tax money? Why?
Absolutely.
I'll let it take a long time.
Yeah,
So,
take forever,
right.
it's mine.
So, question?
This is a smaller scope. Right now, a closing didn't happen last week on Friday. The buyer found out he had some debt at the table. And so what the strategy is that he's borrowing the money from his 401k to pay off his debt, so that it's not affecting his loan or debt to income ratio. Because it's his money.
Yep.
Right.
And then he'll pay himself.
Yep.
So he's not going out to make a loan
Yeah.
to get it done.
Oh, yeah. When people come to us and they're talking about they don't have a down payment, I'm always
Yeah, you
like,
do.
what retirement accounts do you have?
And what? and
Whole
what
universal
insurance
life
policy?
insurance policies. What do you got?
Absolutely.
Yep, yep. By the way, 401ks have no income phase out.
Oh,
So you can
wow,
make
yeah.
$1 jillion and you can still get all that deductible. All right. For traditional or Roth. So, in summary, if you can meet the requirements, meaning you have a business entity and you have payroll, solo K, I have a tough time being sold on any other option being allowing you to sock away more money. I just don't look at the numbers. It's not the only way. You got the SEP and the simple, you have the basic IRAs. You can do any of that stuff and it's really cheap. But man, if you can get to this, you can keep so much more of your money. So hashtag life goals. Nikki.
So going back to the Roth IRA and the
Yeah.
income phase out. So does that include our profit too, or is that just the salary we're paying ourselves?
The income phase outs around retirement plans are based on your adjusted gross income.
Oh,
So, but it starts at what, $198,000 adjusted gross income.
I thought it was phased out at 120,000.
That was for single.
Oh.
Or if you're married filing jointly,
So stay
then the
married.
phase out starts at like
Hang in there.
198. Okay.
Get your money.
So, yeah, so I think the solo K, you know, I'm biased because what I'm showing you is a lot of the rationale behind why I made the choices that I made. But you guys are in really similar circumstances because we're in the same business. We have the same considerations around whether we're going to have employees or not. We have, you know, the same nature of our income. There's, you know, here's all the options. And here's the one that I think makes the most sense for someone who's in a similar position to me. But talk to your professionals and get you some. All right. Okay, 401ks. Yay?
Yeah.
Yay? All right.
The cons?
The cons, we covered those. You have to have payroll,
Oh,
right? You have to have a business entity, you have to have payroll, and you have to have those contributions in by the end of the year. That's why every beginning of December, as soon as I asked for my December, my November year-to-date P&Ls as early as possible in December. And we look at them and I say, all right, what's my tax liability going to be ballpark and what moves should I make? Should I max out my employer contribution? Should I run a final payroll and max out the rest of the employee contribution, or should I not? Should I prepay some of my Cook County property taxes on my rentals, or should I not? And it depends. It depends on where I'm going to land. So yeah, it's one of the drawbacks is you have to have those contributions in before the end of the year. Okay, so all right, let's bring it all together here with, if you got an S corp, remember the salary profit split, and you got a 401k. Okay. You have your 50-50 split. Remember, you got half your payroll taxes that are deductible. Let's say you max your employee contribution at 19.5. And let's say you match that from the employer side with 12.5, the maximum, that's 25% of your 50K salary. Your taxable income is only $64,175. But you have a $25,100 deduction. Remember, with this example, is you're married filing
but you
jointly.
haven't added your spouse's income to that.
In the example, I'm saying if your spouse doesn't have income, I can't cover all possibilities, you know, but I have to give you an example. I'm carrying this example through, okay? That means your adjusted gross income is only $39,000.
That's what you think.
Your tax on the first 19.9, you're gonna pay 19.90, and on the next 19.175, you're gonna pay 12%. That's $2,300. Your total federal income tax will be $4,291.
Come on,
Which, man.
like a magic trick.
Now, if you really want to, oh wait, so yeah, your actual income is going to be the money that you put in your 401k and the money that went in your bank account. You between you and your retirement account would have kept $92,350 out of the 100.
Right.
Uncle's getting more than his fair share.
Yeah, I'm a
Right.
little upset with my IRS bill right now.
Your effective income tax rate is 4.65%.
Yeah, that's it. Absolutely. Put yourself together.
Oh, by the way, if you want to throw this in as a variable,
Oh, my God.
if you got a kid under 6 and you take that $3,600 child tax credit, your total federal income tax is $691.
So they can only be under 6?
Well, if they're over, if there's 6 or older, they're $3,000.
Yeah.
So if the kid was 6 or older, in this example, your total federal income tax would be
$491.
$1,291 on a $100,000 net profit in your business. So, but that same person making the same 100 without an S corp and without contributing to their 401k is paying 15.3 in self-employment tax, and then it has a net taxable income of $84,000. Like, it's a whopping difference, right? So that's why we're talking about part of this class. Part of the class name is keep your money.
Right.
Keep it. All right. Aha's excitements on this portion?
Yeah, I think I'm past.
The 50K in salary, I know you were rounding it off
Yeah.
because of the 100, but if that's like, you don't wanna have salary too high, right? Is that
Right.
Good.
You're gonna have to rely on your
Yeah.
accountant's advice based on your income situation and where they want to approach, they might say, depending on what you do in your business, they might be like, hey, why don't you can make your salary 36, make it 40. They might say, make it 24. I don't know. You gotta talk to them. But I'm using a 50-50 allocation is a very, the IRS is not gonna go shady at 50-50. So I'm using that here. You see how the numbers work out with that. It actually worked a little better if the salary was a little less than 50%, but you have to get advice on that. Don't do the thing where you don't pay any salary. That the numbers work great until you get audited and you get socked with all this, yeah, don't do that. All right.
But paying yourself salary, sorry, another question.
No, go ahead.
But paying yourself salary and not on a payroll.
Well, when we say salary, that implies that it is through payroll. Otherwise, you're just moving money from your account.
Yeah.
Right. Okay. Now, Nikki had asked earlier, well, what if you want to do it to where, like, let's say I need 70 to live on, right? Let's say I'm going to profit 100, but I need to live on 70 of it. I need that 70 in my account. Well, you could take 50 as a salary, and now you got 20 other, and you could just maybe, pull that from your corporate account to your personal account on a regular basis as a distribution. Okay. You don't have to take all of the money you take in salary. You can take it as distributions of profit as well.
Right, so like if you've been paying yourself just by like writing a check into your personal account or your business account, let's just categorize that as distribution money right now.
Yes.
And then do a nice big payroll check to make up
Absolutely.
before the year.
Yeah,
Years.
you could go, if you go set up an entity now and set up a solo K right now, you could run a final payroll of 20 grand and put all of it in your 401k.
Yeah.
Oh, yeah.
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 That's the beauty of Keller Williams and Alex.
So,
Real people, realty.
Oh, please.
so here's where we're at. We've hit this little pinnacle slide. I really want to make sure we got to this. It's 5 o'clock. I've got more content. I'd like to get through some of it. So can we go a few minutes over here and get to some other
How
stuff?
many more minutes? I have a.
15
Well,
minutes.
you go ahead and leave.
I have a hairplay. Can I just pick it up on Zoom?
I'm recording this and hopefully all the recording will go through and I'll be able to
You can call
upload it.
me if you want to.
No.
Yeah, I would like to know, I would like that.
Yeah.
recording.
I don't wish to.
I was, but I haven't uploaded it. I think it's local on the computer. All right, so let's see what we can get through, okay? Let's see what we can get through. See what plan you think might work for you. Here's the ones that we went through.
Is that the self-directed IR?
We haven't gone there yet.
Oh.
We're about to crack that open, all right? Okay. There are other accounts, other types of trust accounts that are not retirement accounts, but that have similar types of tax advantages. I want to tell you about them. I'm probably gonna have to take advantage of one of these that I haven't before. There's a few that we're gonna cover. There's an HSA, which is a health savings account. There's a CESA, which is Coverdell Education Savings Account. There's a 529, which is known as a college savings plan. There are others that we're not gonna cover because they're not available with self-employed people and business owners. So we're not gonna talk about FSAs and HRAs. Okay, that's for like big employers and stuff. That's not for us. We are gonna talk about those first three. The HSA, the ESA, and the 529. Health savings account is crazy. You have to have a high deductible health plan. That's the requirement. But it's not as high as you think. The deductible to make it a high deductible health plan is the deductible has to be over $1,400 if you're an individual, or over $2,800 if you're a family. They pretty much all are anyway at this point. So you have to have a high deductible health plan, right? The contributions are tax deductible. When I put money into the HSA, the contributions are deductible. And I can contribute $3,600 a year as an individual, $7,200 as a family. And that's actually more than an IRA, right? This is wild. The distributions are also not, I shouldn't say deductible, I should say not taxed. The distributions are not taxed if they're spent on qualified medical expenses.
And I have a lot of those.
So you get a deduction when you put the money in, and then when you spend it on qualified stuff, it's not taxed. It's never taxed.
Yeah, eyeglasses.
It's never taxed, yes.
So would the never tax money be, example, I know it's gonna be extreme. Instead of my money going to my savings account, waiting for my auto deduction for my health, my plan per month, can it be sent there to the savings plan and then?
One of the few things that's not a qualified medical expense is your premium. Okay, you can't, your health insurance premium is not a qualified medical expense, but damn near everything else
Yeah,
is.
everything else.
You have to have a plan anyway to be able to use this. Is what you say.
You have to have a high deductible plan, but what I'm saying is you have a premium with that high deductible health insurance plan, and you can't use your HSA money to pay the premium, but you can use it to buy just about freaking anything.
Yeah.
I mean, freaking Advil you can buy with it, and it's untaxed, okay? This is a good website here, and I can send this stuff out later, so you have the link. HSA Bank is an account administrator that holds these type of accounts. They have a whole list, and you can go look it up anywhere. What are qualified medical expenses for an HSA? It's all prescription stuff, all sorts of, physical therapy, prescription stuff, over-the-counter medicine, anything medical, toothbrushes. I mean, like,
Acupuncture?
swear you, everything.
Massages?
Yeah.
Is it only for expenses for the current year?
Ask your accountant. I can't answer that.
Is the copay, that's also.
Copays, yeah, you pay that with this. Everything, basically everything that's anything medical related except your health insurance premium. It's ridiculous.
And what, they give you a card or
Water
something?
bottle?
Yeah, you get a debit card.
Yeah.
Yeah,
Yeah.
There's some of those.
yep. And I had one of these for a while when we had a high deductible health plan, and we used it. It was great. It was great. Needs changed, insurance has changed. I don't know how to use this right now, but it's pretty freaking awesome. It's one of the very few sorts of financial vehicles where your money will literally never be taxed.
And do you know if you don't spend it in the 1 year, does it?
Keeps
roll
growing.
over?
Keeps
Can you roll
growing.
over?
It could grow all your life, and you can spend it all on, your deductible expenses, on qualified expenses when they happen. Now, you can't let it all, Nikki, I know you can't let it all grow for like 20 years and then go back and start paying stuff from 20 years ago. You can't do that.
Okay, no, I said I haven't, if I were to start this in 2022, I would wonder if it could cover some of the bills in 2021.
Well, I think it covers when you pay them, right? So like if you're on like payment plans and stuff, I'm pretty sure that's, yeah, go ahead and pay it with that. Yeah. Is that not ridiculous?
Yeah.
The money will never be taxed.
I'm serious, I've been looking like Affleck something, I need something
We had
to
that. It
put
was
somewhere
amazing.
so
Yeah.
I got a lot of knuckle bills.
So this health savings account, are you making money off of the money that's
You
sitting there?
saving.
Oh, just you wait.
You just.
Just you wait.
Lord have
Okay.
mercy.
The money,
Oh my God.
the money could be, what happens with the money when it's in the HSA is what Nikki is asking.
Yeah.
It depends on the administrator. It could be just in cash. It could be in money market accounts. It could be invested in brokerage accounts, or you can actually have it be a self-directed account and invest in just anything. So those are some of the options. I am telling you, it gets stupid, you guys. Coverdell Education Savings.
It doesn't get Alex.
Coverdell Education Savings Account. Your contributions to this sort of account are made with after-tax money. You don't get a deduction for making a contribution here. And they're small. You can't put in more than $2,000 a year. The distributions are tax-free if they use paid qualified education expenses. So that's a very broad definition for these accounts as well. It's elementary, secondary, and higher education, private, public, alternative, like just anything. And it's all sorts of stuff. It's like books and tuition and room and board and services and computers and pencils and whatever, right? Right. So you don't get a break when you put the money in, but just imagine if you put $2,000 in every year for a child that eventually goes to college, that money could have grown quite a bit by then, and then you spend all that money and it's not taxed at that time. You got to liquidate it when the beneficiary reaches 30, unless there's special needs, and you can transfer it to a younger sibling. You take it and attach it to the younger sibling.
I started an account for my son. And he doesn't realize he's in college, and this money will get spent while he's in college.
Yeah.
And he just keeps, and he puts money in it too. And he's gotten over $900 just alone, because it's a stash where he picks his own stocks for it.
Okay.
He knows how to pick stocks.
Yeah. Well,
All the young people do.
you could just do that. If you guys are using checking accounts to save money for your kids' college, why don't you just use an education savings account?
No, we do. It gets good return on this, what I'm saying.
Well, if you do it in one of these, then when the money comes out, it's not taxed.
At all.
Oh.
It grows, and however much it grows, it doesn't matter, because when you spend it on college, it won't be taxed.
Is it 2,000 per child?
Each child get a separate CSA, yeah. So it'd be 2,000 per beneficiary is technically the,
Okay.
yeah. And it's on behalf of the beneficiary, so lots of different people could contribute.
Yeah.
So when you have a kid's birthday party, you could be like, hey, instead of getting me more crap to put in my house, make a contribution to CSA.
We
Yeah.
passed that out, we passed the link out on the.
Yep.
like,
There you go.
And then another thing is,
Yeah, a lot of people
I
out
was
here.
gonna say,
All right. I want to keep rolling anyway, because I think we're actually going to get to a pretty good spot here. Another type of education plan is the 529. Now, this is something different for each state. It's a federally available thing, but the rules are different in each state. So for Illinois, the contributions are deductible for state income tax purposes, but not for federal. All right. The contribution limits are higher. You can put in up to 10K per beneficiary, or 20, I'm sorry, per individual is contributing, or 20K if you're married, filing jointly. You can put a lot more money into it. It's deductible at the state level, but not at the federal level. Your distributions, when they're spent on qualified expenses, are free of both state and federal tax. Okay. So with the federal tax, if you look at federal, you're putting it in with after-tax money, and it's not taxed when it comes out, kind of like a Roth IRA works, right? But for state, it works like that HSA, where it's not taxed on the way in and it's not taxed on the way out. So it's a good plan. The limits are higher than the covered L account. A lot of people think that because it's a state-run thing, that the school you use it on has to be in Illinois. It's not the case. You can use it on public or private colleges and universities in any state. They just have, it basically, if they qualify for federal aid programs, for federal loans and stuff, then you can use it. Okay. And you can use it for all sorts of stuff. Like I said, computers, pencils, calculators, tuition fees, room and board, all that. You can even use it to pay student loans. Up to $10,000 a year you can use towards student loan payments. On the beneficiary or their sibling. So you can even get all that out of the box there. Same as the ESA, you got to use the money by their 30th birthday or transfer it to a younger sibling. Otherwise, it just comes out and it gets taxed. Right? Details are available on both the IRS website and Illinois. The program is called Bright Start. Yeah.
Yeah, that's the one.
So 529 could be another great plan. You like any of these? You gonna use any of these?
Go back to Bright Start.
Yeah, write down which one to ask your financial advisor about. And if they don't know what you're talking about, call somebody else.
Go back for 1 second. Let me get that website.
Oh, just Bright Start. You talking
Okay,
about?
Bright
Yeah,
Start.
just go to brightstart.com. We're getting there. We're getting there, guys. All right, here we go. A lot of the accounts that we just talked about, the way they work is you go to the account administrator. It's Charles Schwab, it's Fidelity, it's, whatever, right? These are, the brokerage accounts, right? And they give you a piece of paper that says, hey, here's all the different funds that we've put together that you can allocate your money in this retirement plan to. You can choose from this list, or more likely they're going to give you like a survey or questionnaire to get your risk tolerance, and then they're going to recommend a blend of these funds. We're going to put 30% of your money in this thing and 6% of it in that thing, and they're going to say here's a recommended blend of these funds. That's how all these accounts work typically, right? And so what's good about that is that they can help you measure your risk tolerance and where you're focused. And do you want to be in more international type funds, or do you want to be in, large cap, small cap, whatever? That's their job, right? They if they're ethical and stuff, then they're good. The funds are professionally managed. These accounts have been vetted. These funds have been put together, and they're professionally managed. There's some value to that, and they can help you with your risk tolerance. The cons are, that's it. It's all you can choose from. That you can't invest in something else when your money is with a traditional account administrator. And ethics don't always play out the way you might think, because a lot of times, such and such fund is having a sale, right? Yeah, we're going to pay you an extra whatever basis point for however many of this product you sell this month. That's how the brokerage industry works. And so you might get sold a fund because it benefits the advisor, not because it benefits you. Or because that fund just pays more on an ongoing basis because they pay on annual assets or whatever. So there's some good things and there's some not so good things about the way that those accounts are typically administered. But you have another option. And the other option is a self-directed account. Instead of the administrator directing the account, you direct it. And you can basically invest in anything. You can invest in real estate inside of your self-directed retirement account. Right? You could actually wholesale, you could do a wholesale contract in your covered ESA self-directed account and turn your $2,000 into. You could invest in mortgage notes, promissory notes, peer-to-peer lending, private equity and other business entities, mutual funds, stocks and ETFs that maybe aren't available through the other account administrators, precious metals, foreign currency, cryptocurrency, livestock, mineral rights, food trucks.
Food bucks.
Okay, include books. You can invest any of these accounts if they're at a self-directed administrator in just about anything you want. And I'll go through the just about in a second. The pros of this sort of account is that you can invest in nearly anything. See all my little asterisks, those are on the next slide. You have a lot more control, you have full control, which could be good, or that could be bad. You could probably, especially if you're in real estate and you use this money to play in real estate, probably get a lot better returns than putting it into ABC mutual fund. Okay. The cons are that you don't have any buffer to protect yourself from yourself. You can make some really bad decisions and screw a lot of stuff up. And there's not an advisor there to tell you that was a bad idea, right? Now, you could go get another advisor that you could say, hey, here's what I'm looking at doing. What do you think? You can bring it to me and be like, hey, Alex, this is a dumb idea. I'll be like, I did that once, it's terrible. So those are the pros and cons, but it's a really cool option. And you can just go home and just go sleep on this, okay? Your prohibited transactions that you can't use, you cannot use a self-directed retirement account to invest in this stuff. Collectibles, certain coins, life insurance, and you can't, your retirement account cannot do business with you personally, meaning I can't have it buy a rental property and then pay me to manage it. You can't do that. You, your spouse, or the beneficiary of the plan, okay, if that's somebody else, it can't do business with your lineal ascendants, descendants, and their spouses. That means my parents, my children, and their spouses.
Yeah.
If you go straight up and down. Now, it didn't say your siblings.
No.
It's lineal ascendants and descendants, all right? It can't do business with your plan service providers or their fiduciaries. And it can't do business with an entity in which you have majority ownership. So if you break that, you're screwed. The account ceases to be a trust account. The whole thing comes out.
Now
It's
it's a
all
liar
taxed.
account.
It's all taxed. It's all penalized. You're screwed.
Yeah.
You're super screwed. So yeah, don't do that. Now the self-directed account administrators will typically, they have checks in place because they get screwed too if they have their accounts go bad. So they have all their documents and stuff in place. When you send it in, they're going to be like, hang on a second. This person has the same last name as you.
Right.
Tell us what's going on, right? They should be doing things like that. So, all right, let's get to which of these you can do. All right. Remember all those retirement accounts we talked about? You could make any of those a self-directed account. Remember that HSA where you never pay tax on the money and it grows, and Nikia was like, well, what is it invested in? Could be anything you want. And the Coverdell as well. Just an option. This is the stuff that this like go home and sleep on this a little bit. Think about this in the shower. You could use your self-directed retirement account to lend money to a startup business or a nonprofit. You could take an existing IRA or 401k from an old job that's sitting somewhere. You could roll that into a self-directed account and buy a house in it. And all the rents are received into the retirement account.
So what about if they're still currently with the employer?
You can't pull it out like that. Yeah, the employer won't let you take the
So
IRA
what you
away.
just said, Alex, collecting the rent,
Uh-huh.
instead of just sitting in this dormant savings account, can literally be sent to a self-directed trust account, sit there, make money, not taxed
Mhm.
now.
And then when you
then
sell the
reuse
property and all the proceeds go into your retirement account.
But only if you take money out of it to buy the real estate, right?
It has to only be through there, right?
Yeah.
It's got to be a full separation. So all the money that comes from the property has to go into the IRA. Can't take some, right? No, it's got to all go back in, and all the money that is spent on the property has to come from that IRA as well, or from that self-directed account as well, unless it's a partnership with someone who's not a prohibited party. So you've got some boundaries around it, but you can do ridiculous things with this.
Someone who's not.
Yes. Yeah. Yeah. Like Robin and my self-directed IRA could do business together.
Right.
Mhm.
Or your self-directed RAs can do business together?
Yes, they both could. That's right. You could take, again, if you have an old IRA or something, you want to roll in self-directed, you could be a hard money lender.
Yeah.
Go get you that 16% APR and 8 points and all this crap. Your retirement account could collect all that.
So the catch is that you can't touch the profit.
Correct, until you're of retirement age, but this is all, listen, you've socked away money. You can't touch it till retirement anyway. Here's cool stuff you can do with it. It doesn't just have to be an aviation.
You don't have to just stay there until you retire.
Right.
You could be making it work.
What about this? You take that little $2,000 Coverdell education savings account, why don't you use that to give a car loan to your friend's kid to buy their first car,
Right.
and the interest and all the payments go into your retirement, into your education savings account that funds your kid's college.
So you get to play around.
Or maybe, yeah, or maybe that kid wants to start the lemonade stand, and you can be like, well, okay, let's make a deal, right?
You can be a bank.
You can be the bank. Or what else?
Yeah, endless.
Wow.
All right.
All right, my
Well,
friends.
you blew our minds.
But we need that class just by itself. That is huge.
You know what's crazy?
Individual, yeah.
We actually got to the end of it. We're 20 minutes over, but we actually got to the end of the content, and now I know I can probably do this class in 2.5 hours.
Yeah.
Shout them out real quick. If you got ahas and action items, I want to hear what you're gonna do with it, and then please email me your feedback on this class.
What is the next 2 series?
The final one, the topic is going to be real estate investment, but it's going to be very focused on what it means for us as real estate professionals. I don't have a date on it yet. It's probably going to be early December.
Thank you.
I would have done it late November, but we got the holiday and all, and I
Oh.
had shoulder surgery coming up, so I'm like, I'm not doing it again in November. We'll do it early to mid-December.
I found out of this class by accident through LinkedIn. Thank you.
You're welcome.
I think I'd like to be.
I'll let you know.
For the 3rd class. Yeah.
Absolutely.
Are these all recorded?
This is recorded on the local computer here, so as long as I can get the file uploaded and stuff, I'll share it with everybody.
Please.
What was the first test?
The first class was like September 30th.
Oh, that was mine.
What was it? It was, we talked about separating your business and personal accounts. We talked about P&Ls, talk about a profit and loss statement, how to, what it means, how to understand it, what
Was
questions
that
to ask.
recorded?
Yeah, I think the recording's on this computer.
If I can get a copy of that.
Yeah, I've got the list of who's here. I can let you guys know.
Yeah, there's a sign-in sheet.
Any other action items or ahas that you guys want to share before we close it?
I
And-
know
and-
Lily.
I think it's another conversation with Angie, with my, my accountants.
Yeah.
And, what the funny part is, it's Annie, right, my wife, my partner, business partner, sent me, she goes, well, you can just come back and explain the whole thing to me. I was
Oh,
like,
really?
Yeah. So, but she knew what she was getting into when she married, and actually she didn't, but now she does. So I'll be like, there was a thing. and
Right,
look,
yeah.
there's This.
Good luck with that. It took me a month to put this together in a way that where you take these concepts and
Yeah.
break them down and to get it in order so that like
A
each
month
thing
is
builds
good.
upon the
Yeah.
next, you know?
But this is great, man. This is.
Thank you.
So I think one aha I had in the middle is, as because I'm guessing you're test driving these things to be rolling these out more consistently in this market center,
Yeah,
right?
yeah.
Boy, do we need to tell other agents
we
about
do.
it.
This is a
Oh, you
must.
missed it. Guess what?
Yeah. No, this is a
Well,
must to
yeah.
keep us as business
Yeah.
owners.
Nobody's
in the
saying-
mindset of-
Nobody.
None of us, like the
Are you
last
walking out the door,
class,
Kelly?
it's just
Surely, yeah.
all of the little
Probably.
things, commingling money, separating your life, like it's literally setting us up to not just take advantage of these 100% checks that we benefit from, but what do you do with the money? Like, right,
Yeah.
we have to pay taxes. We're not doing that right. And then to actually see, I should have been doing self-direct.
You could have.
It just, with the rent income, it's just sitting there. It should be sitting somewhere making money, and then I can constantly use that to do my own bank.
What I think of with this, as an investor in this market center, I think, as I'm talking to agents about coming here, I feel like helping them with this
Yeah.
is it's beneficial, it's such a KW way to approach it, first of all.
Yeah.
It's so win-win, but it's so integrity-based and like, we're helping people on a
Yes.
really high level.
Life
Like, it really
changing.
matters. Life-changing.
Life change.
So, and that's coming from you, so I appreciate you doing it, and it aligns to me with what I love about this company, so.
Yeah.
Yeah.
Thank
Yeah,
you.
if you can put some of this stuff to work, the amount of money that you could save or grow in the next 5 years or 10 years of your life.
Yeah.
I mean, really, really astronomical amount of money.
I
if
keep
you put
saying
this stuff to work.
2022 is gonna be, this is the first year I'm walking into the year like, oh, I'm so prepared to do stuff, and I'm excited.
Good,
Yeah.
good. Anyone on Zoom want to chime in before we end it?
Following you.
Okay.
All right. Well, thanks for sitting through. I know it was a lot. I know it's a lot. That's a dense
Yeah, I wanna
you.
sleep today.
content and slideshow, but
Yeah.
thank you for hanging in there. And feel free to circle back for questions, or if you need referrals or, whatever, all right? Thank you, guys.
Thank you so much.
Yeah.
So you totally understand.